All right, welcome back, everyone. Hope you guys had a great couple months since the last live stream. So it's been a minute, but we'll get right into it. So let me kind of change the view here, get us going. All right. So as always, you guys can ask whatever questions you guys want. I'll get to it. Obviously, we may not get to every single question, but I try to get through every single one in an orderly fashion. So below us are the topics of today's video. So you can see them in the description. I'll loosely follow them. I don't strictly, I have to follow these, but for the most part, I'll try to stay within those time constraints. So within the next 30 seconds, we'll start the first topic. But yeah, other than that, let's see. Let's go through any questions here. Where did you tag me? I sold everything, yes. And absolutely, we'll talk about this. Dave, we'll talk about Dave. And absolutely, obviously, this is the case. Okay, so right on the 5-minute mark. So the first topic that we're going to be discussing today is going to be, of course, talking about the Iran conflict and its impacts on the market. So yeah, lots happened since our last live stream. Sorry about that. But the main point, I guess that, all of you know what's going on with Iran, but connecting it back to our thesis that we laid out about a year ago, we did a live stream in April of last year talking about the broader framework of how we're thinking about things regarding United States and its framework around the world, how it's bucketing various powers. We covered in Capital Mindset a few of the things with the various committees with the Senate that you could have listened to, public C-SPAN stuff, and in some of those they actually discussed the 4 nations in particular: Venezuela, Cuba, Iran, Russia, as sort of like engagement in either diplomacy or militarily, all of which to eventually prevent a ongoing hostilities, or not ongoing hostilities, but future hostilities with China over Taiwan. So what we're seeing here, as far as the eventual development of that, is of course this resource denial strategy that the United States has been engaging for quite some time, but people get really bogged down in the whole politics of it all, and it boils down to tribalism. Now, with Iran specifically, we're in a position where, of course, the Strait of Hormuz is under contention. This is putting strain on global supply chains, particularly with energy, and more particularly with Asian markets and European markets for energy. So you can look up breakdowns as what percentage of what goes through the Strait of Hormuz, or where it ends up. You can look at natural gas prices in various markets. And for the United States, for example, the natural gas price hasn't moved up all that much. But in other markets, it's moved up quite a bit. For the United States, it produces an excess, a massive surplus of natural gas. But that doesn't necessarily mean that that gas can get to these other markets. In fact, we're set to double capacity for exportation on natural gas by 2029. That's been a big part of the natural gas thesis, at least in the United States. But natural gas in particular is something you got to store in a particular way, and you can't just magically spawn it in the market where you get the higher price for it. So here in the United States, while the price of natural gas is not very attractive to these sellers, they can't do anything about it, given the capacity constraints that exist for getting that natural gas to these other nations. And in particular, what's going on right now, which of course makes it unfortunate for these American natural gas players, is Qatar was hit, which impacted 17% of the natural gas productive capacity there. And that equates to about 3% of global capacity. But again, because of natural gas being, of course, different than liquid oil, you can't just easily transport it from one location to the next. You have to build the infrastructure that allows for that. Now, United States, over the next couple of years through 2029, that will change a bit. But frankly, we probably would need more in order to really abate some of the effects happening in these other markets. Okay, so you can spawn me a higher Dave price. We'll talk about Dave. But we'll talk about Dave later, because right now we will discuss that. Yeah, and that was more of a funny thing. But so kind of coming back to the whole Iran and how it's impacting markets. A lot of people, the most popular trade right now is, you go long oil and you short everything. And that's, I think, how most market participants, when I talk to folks, that they're thinking that this is the easy trade, the obvious trade. And if you look at positioning within markets, it's quite bearish. We haven't seen this level of bearishness since, roughly about April of last year. And what we saw on Monday was the knee-jerk reaction of this market to really jolt up on any news whatsoever. And then that makes it very scary to short, right? Because if you're holding a pretty leveraged short book, you're looking at this market and saying, man, I want to be short, but if anything develops positively, whether or not it's impactful, it could really rip your face off. So kind of navigating through that is a bit tenuous. And if you're trying to go long, well, the benefit of going long is you have patience. If you have patience, you can kind of stick through anything, as long as you're not overly levered. And you can suffer through whatever performance drag in the medium to near term for the longer term benefit. But kind of coming on a high level view, and why I'm optimistic about the markets longer term, is I do view this as lessening the chances of a conflict happening over Taiwan. And if there's any questions on that, I'm happy to get into it. But it's something we've been covering on Capital Mindset for now a year. In Capital Mindset, the investment club, we do have an entire room where we've been laying out the framework for about over a year now on this larger high level thesis regarding the United States, and like frankly what we think is happening. And I think as time has progressed, more and more evidence suggests that it was the case. While maybe a year ago, a lot of people were saying, well, it's more skeptical that that's the case. Although many primary and secondary sources all indicated that was the direction the United States was going in. It just takes a little bit of reading. Okay, so what do you think about Rocket here? Okay, all the great questions, all stock-related questions, I'm saving for the Q&A. So I'm starring you. If you ask me a stock-related question, if you ask me a question related to the topic, happy to answer it now. A lot of Rocket questions. Okay. And I'll star whoever asked about Dave, so we do end up talking about Dave. But related to right now, right? It is back to recent lows. When I say recent lows, I think of recent in the last 5 years or so. Forward PE on this market, I think, is like 21 times. And considering the constituency of this market has changed over the last 25 or so years to be a lot more tech focused, this is considered a lower multiple, especially like when you look at it on a level of multiple relative to growth. So on a relative basis, the market is actually now a lot more attractive than it was, let's say, last year. And if the growth starts to teeter off, that becomes a bit concerning. So you could either say the market is now pricing in a bit lower growth, a bit more concern on that growth, which would be fair. But if the growth doesn't stall, then the multiple now actually will look really attractive. And one of the valid concerns about what's going on in Iran is the impact on the broader economy. So impact on the global economy, I should say, because oil prices, while in the United States, aren't actually as high as they're being impacted in other parts of the world. The United States and the companies that are making up the bulk of the constituency of the S&P, these are global businesses. They derive profits from all the corners of the globe. So if there is some form of recession or deep recession in other parts of the world, that will impact earnings on, even some companies in the Mag 7. And of course, the supply chain question on various inputs for things like semiconductors can also be very sensitive. So if anything were to impact that could also build up some problems for the likes of anything that is downstream of data center capex investment and the like. So those are things that everyone's paying attention to, and those are very valid concerns. However, for now, it doesn't seem like they're having that much of an impact. And at least companies, we haven't seen any sort of preliminary update on guidance or anything of the sort. And for many of the businesses out there, they may actually continue to see strong growth. We just got manufacturing data from the United States, and we continue to see, and think these are some of the things I cover on X. I repost some of the folks that I think have a good eye on this. And we are continuously seeing, from what they have seen as a trend for at least 6 months or so, the United States is picking up meaningfully when it comes to, let's say, the real economy or the old school economy, while the other parts of the new economy are still looking quite strong. And those are some of the folks that, we've made the case. We've been in some sort of rolling recession since about 2022. You look at various industries that indicated as such. You look at, for example, trucking. Trucking seems to be exiting this rolling recession period, and there's actually a whole host of tailwinds going on in the trucking sector, both from a volumes perspective and a rates perspective. So the rates were under pressure because of what was happening with the supply from, potentially a lot of illegal drivers on the road. And so that was getting cracked down at the same time the volume was expanding. So this is driving rates extra high right now. And sort of like the finally, they're seeing a recovery in that business. So you see companies like ODFL, JB Hunt, et cetera. All these businesses are getting quite a bid as of last year. For full disclosure, we're long ODFL and JB Hunt. I need to remember to make disclosures throughout it. France, Lamau. Okay, so Iran rejected the peace offering. Okay, great questions. All great questions. Okay, that one I'm answering. There's one question I won't answer. Why is the China-Taiwan conflict less likely? Okay, so great question. So the way we kind of viewed the United States, again, last year, we made a whole thesis about this. There was a live stream I did for YouTube, and then there's a private live stream that I might just make public. But the high-level discussion was the United States viewed that conflict with China as something they wanted to avoid because no one wins in that. It's just problematic for everyone. It could be highly destructive economically to the globe. So if you listen to various military analysts, the generals themselves, when they testified before Congress in the various committees, there was one that I took plenty of notes on. It was 12 hours long. You could have watched it live on C-SPAN. I think you can watch it now on YouTube, broken up in 4-hour increments. And it happened, I believe, at the tail end of 2024. So Biden was still in power. And the whole theme of it was discussing avoidance of a conflict with China, on and on and on, and various ways of how, high level, not anything in super detail, of like how they would go about it. And a lot of it is about deterrence, making sure that, as far as like a logical actor would be concerned, it would not be worth it. So a few of those things is mainly on the theme of resource denial and making it so that there's less of an ability to counteract. And so you take, for example, Venezuela, which was more of like a resource access point and a tactical strategic location for China, where there's Cuba as well, Iran in the other case, and Russia is sort of like this tentative ally. So those 4 nations were named in that discussion. And all 4 were named as being targets of either from engagement of diplomacy or engagement militarily. I'd imagine, without naming them, name dropping specifically which one falls into which, that Russia would be more the diplomatic one and the others would be actually more leaning on the militaristic side. Who knows? We have to see about Cuba. But the whole point of denial of resource access makes it so that a conflict in Taiwan becomes a lot more strenuous, a lot more obviously not worth it. That's the stated goal. And so if you look at the energy output from these various countries to China, which China is primarily an energy importer, you can make it so that the military mechanism starts to get starved out, or potentially get starved out. You see it as like a visible threat. If you're, think of yourself in the position of the CCP, it makes it so that you see the vulnerabilities that may or may not exist. And the problem with dealing with autocrats is that autocrats can act irrationally. And so that's why it's very difficult to assign, a logical framework for the actions of an autocrat. So you could say, like, and this was a discussion, if you recall, back before Putin invaded Ukraine, there's no logical reason to why they should invade Ukraine. In fact, many military analysts were saying that would be a blunder, that would make no sense. And that was a lot of the very intelligent people making denial arguments about why it would even happen. Of course, it happened. And that's the whole story, a tale as old as time. You can go back to multiple moments in history where autocrats made very strange militaristic decisions that, in even hindsight and at the time, didn't really make too much sense. So that's the difficulty about predicting 100% if there's still going to be an invasion happening in Taiwan. I just say from a logical framework, it becomes less and less probable if there are certain succession points that happen for the United States. So United States from the Panama Canal, again, this situation in Greenland, Cuba, Venezuela, Iran, a lot of these and a lot of the tariff negotiations and concessions had to do with China. It's not a coincidence, for example, that Mexico put the 50% tariffs on Chinese goods. I think it passed in like January 1. And from last year, we were covering this, that was part of the negotiations with Mexico, as like part of that was, targeting China. Okay, so why it makes it less probable for Taiwan? Again, it's just like, in summary, makes it visibly less attractive to even attempt to engage there. And that's the goal, right? And so if that happens, you can be structurally bullish the market beyond, the scuffle that's happening right now. So longer term, that's bullish if there's no conflict. That's bullish if there's, just business as usual with Taiwan. You can hold companies like TSM and feel a little bit better, or any of the other Taiwan companies that are all integral to the supply chains of various technology firms. So that's high level why. If you have a specific question you want me to like narrow down to, because it's a very big topic, and frankly, when you get to that big discussion, that's again something that covers like a year's worth of content, a year's worth of coverage. I don't know what you don't know. And so that's we could spend like the entire live stream just on that, if I'm being honest. Okay, so let's see. You said preferred stock ETFs were garbage. Is there? Oh, yes. Yeah, so the only preferred stock ETF. Well, actually, I almost fell for it. I'll answer this question in the Q&A, Steve. I got to keep on the topic. It's very easy for me to get passionate and start answering every question. Around rejected. The peace offering looks like it might take a while. Well, any sort of like peace negotiation or offering has to be under the terms that the United States wants for it to be useful for the United States' goals. Iran can say whatever it wants, do whatever it wants, but at the end of the day, I think people are talking way ahead of themselves, especially people with who are not, I'd say, very knowledgeable on the subject matter, are talking ahead of the situation. And if anything, they're going to make themselves look a little silly later down the line. It's best to, be patient and observe certain things, because I see a lot of people jumping the gun a lot, and then comes out, something's not true. I'll give you an example. So a lot of the people were saying Iran was holding back. And for normal people, I feel like it's fine, because, if you're just talking at the dinner table and saying something like that and being silly, there's nothing wrong with that. But I saw people who charge for macro research suggesting that. And that's where, I do find you've invited someone to insult you, because you can't be that stupid if you're someone who's like, charging for research and saying, yeah, Iran's holding back, and you just like parrot Iranian propaganda. So I'm saying with like any information that comes out of Iran specifically, you want to just like sit and digest it a little bit more than kind of jumping to it. And I feel like a lot of people, especially in the West, are underestimating. I did post an X post about this regarding informational warfare, and why there's folks on YouTube who I'll shout out. Ryan Macbeth is a great person to go check out, subscribe to, and listen to regarding on things pertaining to informational warfare campaigns, the Iranian war, etc. So those kinds of folks tend to be decent, very, very good, especially because it's free, by the way. So a lot of why he created his channel is because to combat misinformation, especially on matters of the military. So folks like that do a great service in posting that content for free on YouTube. So shout out one more time, Ryan Macbeth. Go give him a follow. much larger channel, and I'm happy to see that he's got a lot of traction. But on the coverage of bots, informational warfare campaigns, etc., it is very prolific. You see it all over X, you see it all over Reddit, you'll see it all over your favorite social media sites, how active the bots are, even here on YouTube. And they're pushing a particular narrative because they're trying to convince real people. And when they convince real people, that's the success rate. The success measure is convincing real people who have real world influence on whether policy, through voting, etc., because that's their only strength. So if you're talking about, the U.S. adversaries, they know from a kinetic warfare perspective, there's no victory there. So strategically, the only way they can achieve some semblance of victory is through informational warfare tactics. And so there's actually some literature you can read up on. So if you look into, the three warfares doctrine, and I actually, let me go to the specific one you can find or read up on, either through primary sources or secondary sources, because you got to get the translated pieces of information. But, for example, you can go into PLA Army Work Regulations, Chapter 2, Article 18, Title 3 Warfares. So that's going to be mostly about official PLA political warfare strategy, and it talks about media, public opinion warfare, psychological warfare, and legal warfare. So those are the three, and how they implement that in peacetime and wartime. And so right now we're in this peacetime. So legal warfare is utilizing the legal code, the laws against the nation in question, and then focusing on forming public opinion, changing public opinion in order to affect policy in favor of themselves. And so you can think of all the things we are seeing, this fast-paced energy with the Iranian conflict, with anything, that's all part of the informational warfare campaign. And so all that to be said, you could summarize that and dumb it down to, there's a lot of fake news out there. Right, that's the dumbest down version I can give you on that. There's a ton of fake news out there, and there's a lot of people who want you to believe certain things. And you got to be careful about what people want you to believe. And so there's no easy way to really dissect that into something simpler than what I just laid it out. So I'm just shouting them out. I think provides great content. And for this particular thing. So I say, if you haven't given him a follow, go give him a follow. Okay, so coming through here. Okay, great question. Starring you. Thank you. What's my favorite AI play here? That's a star. TSM at this price. I'm adding more. I also have been adding more. There was a key level at 330, but that's all I'm going to say for that question. Disclosure, we're long TSM. Got to remember to do that. We're fine. No liquidity crunch visible. TSM, yes. If it's something short that I could say yes or no to, I'll answer it. Don't worry, I won't wait till the Q&A. Thoughts on insider selling and Dave? Not a problem. I'll start for when we talk about Dave. Okay, so the stockpile last year is worrisome. Yes. All of these were worrisome signs. Starring this on Microsoft. All right. So if there's any questions on the Iranian conflict or anything like that, I'm happy to answer it. Hi, how is UNH here? Is MOH attract? Okay, so I answer this later. All right. I love all the questions on stocks because we'll get to all of those. But the next topic we're going to cover is FICO. All right. So yeah, I'll wrap up the Iran discussion and saying okay, what are the bearish points? What are the bullish points? So bearish points is we got to keep an eye on what's happening globally with the economy. So the stressor points will be, of course, the Asian markets, the European markets, what's happening with the consumer. So keep in mind with energy, we have that's a necessity spend. It's not a discretionary spend. So if that's going to take away from discretionary spend, and so that spend, which would be someone else's income, is going away. It's not the same kind of inflation. So that's one thing that you might also want to be worried about. Central bankers being a little bit dunce about this, but it's pretty common to learn this in economics class at least. But I'll explain it to you in the way you can say, if you understand something, you can explain it to a 5-year-old. So the point on inflation, like what it is that the Fed tries to impact with inflation using or manipulating the federal funds rate is demand. So demand side. So they're trying to manipulate the demand side of the curve or of the chart. So the demand curve, aggregate demand, up and down by changing what the interest rates are. But they're not really, and they can't impact supply. So if you have oil or energy going up, which is an input cost, you have what's called input cost inflation. So things become more expensive because what the cost of the inputs to various services, resources, etc., goes up. The cost of transportation goes up. Then that's in some ways an input cost for a product. So all of that, if that goes up, we have input cost inflation. If they raise rates into that, you can in fact lower the inflation, the price increases, because you can harm demand, you can harm aggregate demand, but that's like a self-defeating thing. So the reality, the Fed doesn't have tools to impact or combat input cost inflation. It is more of a tool. The tools that they have at their disposal really are more about affecting aggregate demand rather than supply. So all that to be said is, that's something to look out for. If for whatever reason the Federal Reserve decides to do something stupid, they can. I mean, it's not like it's impossible. That's something also you want to look out for, and that could be problematic in and of itself. But yeah, just paying attention for how extended energy prices are elevated in various markets. Like I said, for the U.S., I'll share this with you. It's kind of like a little stupid chart I put together. Took me not too long. The wonders of AI, this is what I like to say, the wonders of AI. But it illustrates the point, I think, in an easy to understand manner, and gives us a little bit of perspective. So this is kind of a high level view, right, of what oil looks like since about the 1970s. Right, exactly 1970. And so what I tried to do here is illustrate to you the real cost. So if you ever wondered, I don't know if many of you have ever thought this and said like, oh, yeah, by the way, this isn't up to date as of today. This is as of like last week. So, hey, why is the price or a barrel of oil been, roughly the same price or range bound for 20 plus years, or for most of some people's adult lives? Well, if you're wondering like what that looked like on an inflation measure, inflation adjusted, so in real terms, things haven't moved too much. And in fact, for a while now, the cost as a percentage of people's income has been coming down, which is a good thing. And in fact, for commodities, this is good. This is positive and very healthy. Now it's spiking up. We're still not at the levels we were in prior recent extremes, but it's still proportionate, or relatively worse than where we used to be. But in order for it to rise to where it was inflation adjusted, for example, in the 2008 period, it would have to double, for example, from today, and that would, inflation adjusted, be roughly the price where it was before. It doesn't have to go up to the 134 peak. It would have to go up to about $200 per barrel to equal, the similar impact as back then. And some of the things that have, gotten better over time is we've gotten, as on a per unit basis, a bit more efficient on energy usage. So cars have become more efficient and the like. And across most of parts of industry and society, things have become more, not less efficient. And things will continue to gradually become more, not less efficient, as technology evolves. Aggregate demand for oil will continue to go up. Don't mistake that. Me saying that doesn't mean, oh yeah, the demand for oil will go down. No, demand for oil will probably go up, but on a per unit basis, each unit of output is consuming less and less oil over time, and you're just getting more bang for your buck from that. But yeah, I just wanted to share this with you, kind of ease off the little doomerism that you constantly might be hearing. So for an individual person, the effect of energy costs over time has actually gradually been getting better, not worse. So that's a little bit of optimism or positivity in your life. So I'll put this away. All right. Let's see. What are unfazed by destruction of energy infrastructure? Why am I unfazed by the destruction of energy infrastructure? Because if you're talking about what happened in Qatar for natural gas, that's my follow-up question. Actually, before I continue on that, my follow-up question: are you specifically talking about that? Are you talking about what's going on in Iran, like what we destroyed in Iran? Well, we as in the West right now. What specifically? On the Iran war, gas will be more affected than oil. Yes, exactly. So I just mentioned that. I don't know if you were here. I like 10, 15 minutes ago, specifically mentioned Qatar. No. So hold on. You clarified global exports. Okay. Because it's 3% of total global supply, and it was 17% of Qatari output. And the caveat around the 3% of global total supply that I gave is that the US has a ton of gas, it just can't get it to those markets. So it impacts a lot of those markets disproportionately. And that's the problem, right? So when we're talking about the United States and natural gas prices, we don't see much of a movement. You can see that if you've been an investor in natural gas companies in the United States, you should know this, or you have been paying attention to the price of natural gas, at least for the US market. And we're going to double export capacity by 2029. We might accelerate that now because of what's happening. Because from what I remember through my research, it was doubled through 2029, which a lot of projects come online this year in 2026, thankfully. And then thankfully for these companies, by the way, because they can take advantage of the better prices. And then a lot of the projects that were not really greenlit yet, but they were waiting a permit approval beyond 2029. So there's a little bit of visibility beyond that, but they're not approved yet. But now with everything going on, maybe they get some accelerated approval process, and we actually start to update our projections on capacity coming online by the end of the decade, and it increases even more. Who knows? We don't know. But that would be interesting, right? Okay, so other than that, let's move on to FICO. I'm glad we can always come back to a topic. I don't like to skip to a new topic. So just FYI, if anyone has any questions later on, I'm happy to come back. Otherwise, we're going to go on to FICO. So FICO, it's been on a bit of a hate train recently because of what's been going on politically. So we'll talk about really what are the risks overall with FICO, because I think people are identifying the risks well, but maybe exaggerating the end impact of it. So the primary risk is political regulatory, right? Not so much. I'll talk or briefly mention sort of like an off chance risk of these, neo fintechs coming online and really disrupting the FICO model. I just want to mention it, but we're going to put it to the side because I'll explain maybe a little bit later if anyone's curious why that's not that high of a risk. But with the regulatory risk, we have, of course, the changes in requirements for a lot of these mortgages. And so for those of you who don't know, FICO is the scoring system for a whole bunch of loans. The major ones, personal loans, credit cards, autos, and the big one that everyone knows them for, talks about them at least on X, homes or mortgages. And so in the mortgage market, they are effectively control 100% of that market, effectively. Now that's changing a little bit, but I say changing with a little bit of an asterisk, because with VantageScore 4.0, which really is more competitive against classic FICO, which previously was mandated as the standard for a long time and now is no longer, now presents itself as this credible threat. Regulators are looking at FICO and saying, you've increased your prices by an astronomical amount over the years, something going from under $1 to now $10 per pool. And so I wanted to share one thing that, it's funny to me, but some people, it's maybe like a strange humor, but some people found it funny. So I'll show it anyways. But this is the topic I will share with. This is from Holly. And I couldn't stop finding this funny. This is probably one of the funnier statements I've ever read in my life from a politician, but let's read it out loud for you. For 2026 alone, FICO doubled its per score price from $4.95 to $10, a more than 100% increase for the identical product offered in 2025. This single increase has the potential to raise mortgage credit score costs across the industry by about $500 million. These costs are ultimately borne by borrowers. They are essentially damaged first-time homebuyers who often pay for multiple credit checks across several loan applications before successfully purchasing a home. So the reason why that is funny in and of itself is that, I imagine the conversation would go something like this. Person one says, no, I was going to buy the $500,000 home, but I just can't make the numbers work. Okay, why is that? The second person would ask, and then the first person responds, oh, well, FICO increased the prices to $10, so I can't afford it. And then person two responds again, well, don't worry, I know that Holly is fast at work trying to lower the price. It's a $500 million burden on a $55 trillion market. That's just crazy. And then person one then responds, of course, in good gesture, thank goodness for taking it to FICO and not getting distracted with the 3 to 6% agent fees and MLO fees. If he manages to get them cut the price to $5 again, I'll be able to afford that $500,000 house. Okay, so long story short, with that whole imaginary conversation, the premise that the impact on first-time home buyers is the FICO score credit pool is, I don't know, laughable to say the least, because that's definitely not the biggest impact hurting first-time home buyers in the United States. I can say that. And FICO also is moving much more towards a performance-based fee model, where it's going to be the $5 pool per pool, and then a $33 fee on the successful or the initiated pool, right? And what I mean by that is like a successful issuance. I think they say issuance. So upon issuance of the loan, it goes to the $33 per pool. And then so the total impact on that is estimated to be at a high point on the current volume. So I already did the math for you. Roughly, it's kind of we're increasing it, or rounding up, I should say. The word escaped me, to about $600. So it's really 500 something million dollars. And that impact alone is going to go pretty much straight to the bottom line. So this performance fee model is much more attractive. So it's like a price increase without a price increase. So it addresses the senator's other comment, or the second part of his comment, discussing the multiple credit checks across several loan applications versus actually purchasing a home. So it's again staying back at the $5 fee and then charging the $33 fee upon the successful issuance. So again, performance-based fees, which that model is going to be fairly attractive. And like I said, rounding up $600 million in terms of total potential impact. And then the company guided for about $300 million positive impact in 2026 based off that pricing change. So it could be more, it could be less, because a lot of those estimates, both the 600 and the 300 million, are based off of current volumes. And keep in mind, the current volumes are actually at a low point. So we could actually have an increase in volumes if something were to happen in the housing market where people start buying homes at normal rates again. But for the time being, we're at these lower rates. And so we're having to use these numbers in order to calculate the total potential this will have as an impact. Just go with management's guidance of about 300 million. I think you're safe. That they probably beat that. I don't know. Maybe not. Okay. How do you think the effect on semi manufacturers from so yeah, we'll come back. So I did mention that is something to watch out for on the straight question. So coming back to that. But yes, the helium in particular, that some people, thankfully you brought that up, but the helium exports is actually one of the biggest impacts on semiconductor manufacturing, and that could be an impact more critically on data center investments here in the United States. So that's one of the things I said we should watch out for. But that's all to say, like, I think again, people are underestimating the outcome. They're predicting the outcome, and I think the panic is already, let's say, people have concluded how this is going to end, I think, prematurely. and underestimating, let's say, as far as the conventional military, because one of the things that the United States has proven to be very good at is dismantling and destroying conventional militaries. Where it has a problem with, in for example, Iraq and Afghanistan, is fighting insurgency, which is a bit of a different battle altogether. But if your goal is to absolutely wipe the floor with military capabilities of a conventional military force, then I wouldn't dismiss the US's military's ability to do so. And then we don't know what's going to develop with the Arab nations around it, because there's this like teasing that they're going to also join much more meaningfully. We assuming too much now is perhaps a fool's errand. But there's a whole discussion we had about like the whole Iran situation, because I think we've been talking about Iran for a bit. From an investing standpoint, there was something that had to be done there in order to prevent something that would be much more of a black swan event than people might give it credence. Because I would call it gray rhino, but there's a lot of people in denial that it would ever happen. So I call it more black swan. Okay, so great questions here. KPG. My video yesterday crashed, Dave. The interview. Oh yeah, so shout out to so we did an interview with the Dave management team, and I highly recommend everyone who's curious or interested on Dave, go check it out. And we'll talk about Dave later today. I'll start this on KPG. Is there any information about private equity that reframes the risk reward proposition for those names? No, there's no new information that changes it. There's a lot of the, let's call it newsreels, highlights on what's going on with redemptions. But if you read closely on a lot of what those redemptions are, it's a lot of the retail side, where maybe in some foolish way the PE firms thought that they could engage retail investors in the same capacity that they could pension funds or endowment funds and the like. And so this wave of redemptions, which is scary to look at, that should have been a whole section. We'll talk about this in a whole section, because there's a lot to get into. I'm going to start your comment. We're going to come back to private equity, because I don't want to just give you a small thing. Let's talk about Netflix. So we just passed FICO, but summarizing FICO, such so we're good on time. FICO, great business, I think, is getting to attractive levels. So for full disclosure, we are long FICO. It's one of our smaller positions, so this is something that we're potentially looking to build up. But at $1,000 a share and below, it's for the first time in a long time finally getting attractive. I know Dev Kantasaria, super investor, very popular, speaks very well. This is one of his largest positions. I love the way he sort of thinks through businesses. And in the case of FICO, I think he was right in that the forward growth profile of the earnings might be underestimated by folks. And this that's happening now, in my view, is a lot of noise. Actually, I apologize for anyone waiting on Netflix. I'm going to extend our discussion on FICO, because there are things I did not discuss that are very important. So we're going to push Netflix back to the 55-minute mark, and then we're going to push back memory and cloud to the 1 hour, 10-minute mark, and then we'll do Q&A at the 140 mark. So I can't disrespect FICO like that, because I didn't even get into some of the other parts that make it more interesting. So one of the biggest moats with FICO, and so some of you are like, whoa, you're changing up the time scale. All right, so if you refresh the stream, you'll see the new timestamps, because I just put those in. Anyways, coming back. So FICO's moat should not be underestimated. It is a natural moat of sorts. It's similar to the moat that S&P Global has, that Moody has. So lenders, originators would always rate their loans on the FICO scale, on the FICO system, for liquidity purposes. It is not worth the savings that you'll get on the haircut you'll receive in the secondary market. So a lot of studies have indicated, there was one from, I think it was Rutgers University. I could be misremembering who did the study. But it was showing that the GSEs like Fannie Mae and Freddie Mac, roughly 60 or more than 60% of their loans had a noticeable higher Vantage score than the FICO score. Now, this is supposed to be against the rules to do this, but it seems to be obvious that there's this selection bias occurring within the market. So what lenders would be doing was taking the Vantage score loan, the higher Vantage score but lower FICO score, dumping those onto the GSEs, and then keeping the ones with the higher FICO scores on balance sheet. So why is this? Well, part of the changes in regulation that made it perverse incentives was the allowance of utilizing whichever one, trying to equalize Vantage score and FICO score. And you got to think about these GSCs as like non-natural entities. They don't act in let's say the most direct market-oriented manner. Because they are a lot of it is done through rules and regulations arbitrated by governments and bureaucrats. So in this case, they equalize the value level, and they would take the higher one and show that to the GSC. And the GSC, when the lender sells them a loan, if the score is really low, they pay some form of premium or some form of fee to the GSC that compensates for the risk. So, I'll give you a very crude example. You listening to me, you're the GSC, I'm the lender, I'm the originator. So I originate these loans, and I have these loans, and we'll just make up a really low score. This is like a 600 credit score on FICO, and I'm going to sell it to you. Well, because you're going to look at that and say, well, that's a high risk loan. I'll buy it from you, but you have to pay a fee. And so that fee is a loss for me. That's less profits for myself. So we engage in this transaction, and I'm a little bit sad. But now with this other example I'm going to give you, same score, but let's say the person scores 600. Let's be extreme about it, but because I got to admit, this is maybe a bit more on the extreme side, but to illustrate the point, 600 FICO score, so same thing. And then they say they have a Vantage score. Again, let's be extreme about it. It won't be this extreme. 750. So the Vantage score of 750, FICO score of 600. And then I'm going to look at that and say, I don't want that. I'm going to go to you, the GSC. I'm going to sell it to you, but I'm going to show you the Vantage score. And then you have to look at them equally. But I don't have to show you both of them. I can just show you one of them. You have to accept them both as equal in standing. So with the Vantage score, I show you that one, 750, and you buy it off of me. And I save on this fee. I don't have to pay that fee. So more profits for me. And then I look at the other loans in my book, and I say, okay, these are all the higher FICO score ones. I want to keep them, because then when I go to the secondary market, because this is one market, this is just the market with the GSEs. But then when I go to the secondary market, I'm looking at this market and saying, okay, I want to sell these loans. If I don't have a FICO score to communicate to the market, then I am going to get a nice haircut on those loans. So I have all of them measured in FICO. And that gives me or guarantees me the best liquidity, the best price for me selling those. And as a lender, as an originator, there's no reason not to take that risk of liquidity on any of these loans. So I hope that makes a lot more sense as to like why it doesn't really matter. And uprooting this mode is way more difficult than just like some senator or some regulator like Pulte coming in and saying words. You got to almost like put a gun to everyone's head, every market participant in the secondary market, and somehow change their opinion on FICO and Vantage, which is not easy to do. It's way easier said than done. Good luck to you. Now coming back to the like, let's say environment where and why FICO still probably be used by all of them. It's like, well, why not have both of them? Because if you have both, you can, kind of intermingle and do the exchange that we were just discussing with the GSC. But if you keep it on your loan, so you want to see what the FICO score of each loan is, if you want to keep it on your books, you're going to have this adverse selection, right? As they called it. And actually that's the best description of what it is. And you're going to keep all the good ones and dump all the worse ones, because it's not necessarily bad. That's another thing I should emphasize. It's like, it doesn't mean that they're trash or it's garbage. It's just not as good, and you don't get as much of a premium on those, or as much of a let's say the price that you want, I'll say, because not necessarily premium, but the price that you would want on those loans or pooled assets. Now let's talk about a little bit these like neo fintech alternatives. A company that I think is a pretty good. It's a good company, and what they're doing is interesting. Something like an Upstart. So Upstart advertises themselves as this underwriter that it has a better underwriting system than something like a FICO. And that's what their whole spiel is, or not spiel, spiel. And they advertise themselves as like, yeah, being like FICO free, better at predicting someone's going to default or not than FICO, and they're an underwriting as a service platform, yada, yada, yada. But when they package these loans into an ABS product and they're trying to sell them, you'll notice that they still utilize FICO, and they actually integrate these or do use these FICO scores to communicate the quality profile of these ABS products. In other words, you still can't uproot FICO. You still need FICO. So it comes back to why I use the analogy of FICO being this entity that's very similar to S&P Global or Moody's. You could cheap out. Like you could most definitely cheap out on your loan and go for a second rate rating agency in the case of S&P Global, Moody's, et cetera. And you could cheap out also with FICO and then go with like Vantage Score. You could do that, but you're going to pay for it somewhere else. So that upfront cost that, by the way, again, it's super tiny, you're going to pay for it elsewhere. Now, there are lenders out there that do exist that utilize Vantage Score exclusively, but they're very different from the other ones that we've been talking about. So again, for example, in the case of Upstart, they are a seller in the secondary market, you packaging these loans into ABSs and then monetizing that. But when you're an entity that is looking solely for storing the loans or whatever packaged loans on your books, and these are smaller loans in general, then maybe you're going to care more about the cost of each credit score rating, and you don't really care about the liquidity aspect because you're not planning on selling them. So one of the banking entities that I always point to is Synchrony Financial. So Synchrony Financial moved to the Vantage Score system not too long ago. And the purpose of it is, like, if you look at Synchrony, they're not in the business of packaging loans into asset-backed securities and then selling them. They're really about producing these assets, these shorter duration loans. Think of like, oh, I bought a mattress with the Mattress Firm credit card or whatever, a store credit card, branded credit card, and you're financing it. So that's what Synchrony does. They're involved in that kind of stuff. And so, okay, you buy a mattress, and your mattress can cost, between whatever it is, like $1,000 to $10,000 for like a crazy mattress, and somewhere in between there, right? So the cost of the credit pool for that kind of loan becomes a bit more impactful than, I don't know, a car loan for $50,000, $60,000, $40,000, or a mortgage that's in the hundreds of thousands of dollars, or a personal loan that could be anywhere from like 10, 15 to 100 to upwards of 150, 200, 300,000, however much you want to go crazy with the personal loan. So those are very different, and that point, that aspect is very impactful to like whether or not a lending institution is going to favor Vantage over FICO. So Synchrony is one of those entities that's biased towards Vantage. In fact, I think they're exclusively Vantage, but all of it's like on balance sheet loans. They're not looking to just spin the flywheel, not the flywheel, but the rotating door, and move capital around like that. So if you're going to do that, FICO's the way to go. And that's nothing that a regulator can really prevent. It's destroying that is like, good luck, easier said than done. Now, that being said, how do you feel about the credit bureaus? Well, the credit bureaus, I'd probably stick them also in the they're interesting, they're pretty good. But with that being said, I've covered everything I wanted to on FICO. If there's any questions, feel free. But we're going to move on to Netflix. So with Netflix, they had the denial of the deal. I think with with Netflix, we got really positive news because, to be honest, what I was worried about as a longer time Netflix shareholder, and full disclosure, we are long Netflix in the fund as well. But the concern I was starting to get with Netflix was they were going to overpay for these assets. The assets were good, high quality. I like them. But there is such thing always as paying too much for something. And in fact, I think the ideal outcome happened where Paramount got the assets at a crazier price, which puts them, in my opinion, just my opinion, in a weaker position going forward, and puts Netflix in a stronger position because out of it, Netflix actually got a payday. Now, what I want Netflix to do from that payday is still invest in content. The thesis behind Netflix is frankly extremely simple. It's a business that focuses on spending money on content. We subscribe to it. We as users subscribe to it, and they keep spending money on content. So the only things you want to worry about is what's happening with the relevancy of the content, as long as they are getting engagement with folks, where people still look at them as the standard subscription, then they're good. They don't really care. So their threshold for engagement is only as much as is needed for you to not consider canceling. That's another thing people don't understand. So let's say I don't watch Netflix only once every 2 to 3 months. That doesn't matter, as long as, because everyone has a different threshold, as long as I maintain subscription. If I maintain the subscription, yes, of course, the argument is the more you watch Netflix, the less likely you are to unsubscribe. Absolutely. However, everyone's threshold there is different. Some people will watch Netflix once a month, and that's enough to justify the subscription. Netflix doesn't care. They got the subscription. Only in the advertisement tier do they start caring about the actual engagement hours, because they want to advertise to you, which is still under monetized, by the way. And that's something positive. I'm looking forward to keeping track of Netflix and making sure that in that realm, they're continuing to gain traction and improve there, because there is a lot of upside embedded in just the Netflix ads. In the Netflix subscription point, there's still pricing power that they maintain. Back to the original Netflix videos I made in 2022. Parts of the examples I gave was showing the cost that people were used to paying for content for cable television and what they were paying for all the streamers. And if you combined all the streamers together, you were still way, way, way below cable television subscriptions per household. So we're still below that level, believe it or not, today. And depending on what plans you pick between the major subscription providers, you're still even way below that. So because some of them are free-ish, some of them are ad tier supported or ad supported tiers that make it a lot cheaper. And you're still way below what people used to be paying for cable television. And again, if you even go further than that and do like an inflation adjusted measure, it's even more crazy to think about. But yeah, Netflix, as far as simplicity of modeling Netflix, it's very simple. It's one of the easiest ones that you could think of to model. And when you're looking at subscriptions being so steady, it's almost viewed as and I think rightfully so, as a safety stock. Now, going to some of their competitors, right? We talk about Disney. Disney, I think, has wonderful assets, but it's completely misused. I think that there's a lot of potential in Disney. It's just squandered. But I'm always watching Disney and cheering for them to change and become something that's like a lot more they utilize their assets better. I'm looking at the new management team, the new CEO coming in, and I'm curious to see what he's going to do. But Netflix, being their model more decentralized, I think has more of that creative destruction approach to content. And HBO Max Warner, I should say, merging with Paramount is a wait and see. I'm not too bullish on that merger. I think, in fact, that's going to be a story that's bogged down by the shadow of their debt, similar to what happened to Warner Brothers at the beginning of their existence. Warner Brothers Discovery, I should say, after the merger between Warner Brothers and Discovery post AT&T. So that's been it's kind of sad watching Warner Brothers with great assets, by the way, just getting passed around like it has been. If AT&T had never acquired them in the first place, I think Warner Brothers was a standalone today, because I still remember the day they got acquired. It would have been probably a much cleaner acquisition for something like a Netflix than it was just now. So yeah, other than that, that's basically the whole general theme behind, or not theme, but the idea behind Netflix, behind Warner Brothers, behind Disney. I'm bullish Netflix the most. I believe in the management team has been proven over time. And I think the model is just clean. It doesn't have any of the other legacy stuff that I find to be a bit atrocious. Even though, for example, in Warner Brothers case, the legacy stuff is actually the part that produces much of the current cash flow. So I'm just very happy as a Netflix shareholder that the deal didn't go through at whatever price, and that they showed cost discipline, which is more optimistic to me. I'd prefer, hey, if you're gonna throw money around like that, throw it into more content. There's other smaller acquisitions they could do if they wanted to, but yeah, throw it into more content and focus on what you're good at. So no need to derail the story with lots of debt here. Just never stop your enemy from making a mistake. You know that old adage. So that's something to think about. All right. Let's go into, let me see how we are on the time schedule. So we have a little bit till we get into the next section. If there's any questions on this, I'm happy to go over. Okay, so this is one. Is there a risk for FICO of AI making their superior algo something easier to compete with? It sounds like it most comes from lines of code. If I had to think about it, AI is going to amplify the moats of those who have, let's say, something like a FICO, I would argue, and something like a Vantage score, which now it's a duopoly. I think their moats are going to be more entrenched by AI, not eroded by AI. That's, I think, the misconception a lot of people, attribute. You look at some of the businesses out there today, and some of them genuinely are going to be disruptible through AI more than before, but others are going to be further entrenched. FICO by itself isn't even, let's look at classical FICO. So classic FICO, which perhaps had some things that some would argue Vantage Score 4.0 was better than classic FICO. Even then, despite that, you needed to be far above better, which they never achieved, in order for the market to even think about maybe justifying, because the entrenchment is so strong. You can't just uproot that. There's so much friction from switching off of the FICO-based system than swapping it in for something that's like, oh yeah, this is better. Okay, Upstart says they're better. Upstart says by measuring it, they say they are better at predicting certain things, and yet Upstart cannot simply put their stamp on an ABS and sell it to the market. They can't do it. They won't get the best deal if they do that. So it kind of goes to show you there's more than just, oh, AI will do this thing and then, this is now irrelevant, pertaining to FICO. I hope that answers your question, but if you have a follow-up, I'd be happy to get into it. Long story short, it's much more than just like simply quote unquote better. Although I would argue, like, when FICO Classic was not outcompeted, but it showed that Classic FICO versus Vantage 4.0, Vantage 4.0 was a little bit better. First of all, not good enough. And then second of all, FICO 10T was already out or already existed and was superior to 4.0. If anything, I think AI is going to amplify FICO's ability to further improve data sets. Because one thing that AI is becoming really good at is, harnessing and collecting data. And in fact, you could argue that there is a future, I wish I could talk to FICO's management team about this, but there is a future where there could even be a threat more to the credit bureaus than it is to FICO, where FICO doesn't need as much from the credit bureaus. That's like far out there, first of all, because that's not easier said than done. But it's kind of like, kind of the easier said than done question, or not the question, the same scenario, how it's easier said than done to replace FICO. It's easier said than done to replace the credit bureaus. Both of them easier said than done, but kind of entertaining. It's like, if you think FICO can be uprooted by that, then the credit bureaus could probably be uprooted by that as well. So no, we haven't discussed why prediction markets are rigged yet. I didn't know that this was a story. I know about the whatchamacallit, the new legislation being passed and that helps Flutter and DraftKings, but I didn't know about this. So we're taking a bit of a pause here. Yeah, if there's any questions before I get into the next topic, which the next topic is going to be cloud, memory, Microsoft, Amazon, SK Hynix, and SanDisk, and then we're going to get into Q&A. All right, let's go into the next topic. All right, so by the way, if you guys are enjoying this live stream, feel free to leave a like, share, subscribe. And in the description below is our sponsors, myself as a sponsor and finchat.ai. All right. Is it time to panic? This is a great question. Yes, of course, it is time to panic. What will the next Fed chair do? I think he's been pretty clear. He's looking at being both loose and tight, but in different ways. So as far as interest rates go, I think he's going to be more biased to the downside of interest rates. He's looking, I think, at the right things as far as inflation goes. So I'll bet on bias towards lowering interest rates. How am I tonight? Good. You have not missed the Dave talk. I have not gotten to Dave yet. I thought so. Panicking now. All right. Very good. I'm happy. All right. Next, right on time, 1:10. So we're going to be talking about memory. So when I talk about memory first, and then we'll talk about the hyperscaler second. But first, SanDisk. So should start disclosure. We're long SanDisk. And when I say SanDisk, I'll also say SK Hynix, but I won't bring up the chart. I prefer SK Hynix over SanDisk, but both have been one of the best performers. Well, SanDisk in particular, I think the best performer in the stock market this year. But memory, memory is in shortage, at least we see until 2028. The recent announcement from Alphabet shows that we can make models more efficient, but that does not mean that we don't need more memory. In fact, similar to the other parts, we should talk about SMCI, because if you are a consumer of Chinese propaganda, congratulations, you fell for it again with the whole DeepSeek. So, and every time you hear someone say that DeepSeek and the others came up with something while using less resources, just know they don't read. Okay, but they didn't read even before, because even the folks who were a lot more familiar with how these things operate, we're always skeptical about that. It's like they weren't calling them outright liars. Tends to be that people with those temperaments don't like to be so confrontational, but they would express a high degree of skepticism. Well, what we know now, especially through SMCI, which, oh my gosh, if I told you, like, we did talk about SMCI very likely smuggling stuff to the Chinese. One of our club members who pitched SMCI back before COVID, or sorry, not before COVID, I apologize. Getting my my years mixed up. I believe it was like 2021, Prisley, I'll shout out his name. He pitched SMCI, and one of the things in his pitch, he talked about the risks with the CEO and the questionable things, like how obvious it was. And by the way, from my knowledge, Prisley has no auditing background, but he's a very intelligent person who can, teach himself how to read financial statements. And as far as like what he picked up, he laid it out plain as day that was like a massive risk for the stock. And by the way, he never participated at the time where SMCI had already crashed down, but it was a big winner for him. But my point in only mentioning that is that way back then, he identified this as a key risk. If you go back to the original conversations and write-ups from him in the club, you will see him talking about this being a risk with the CEO, that he was a very questionable person. And now that he's indicted. But anyways, circling back to like what the whole point of that was, we now know without a shadow of a doubt that the Chinese were getting access to the latest and greatest stuff illegally through SMCI. And that's you now know. So pay attention to all the folks that were or maybe still are parroting that message that the Chinese are OP and they're just making all these useful models. Hold on, give me a second. I got a phone call. All right. So repeat this here. So, guy, great work ethic. Yes, he has. He could have been retired, but instead he's going to work. Yeah, not all of us have that work ethic. The guys putting in the sweat constantly. All right, but coming back to SanDisk, SK Hynix, even Micron, Samsung, all of these guys. You have what looks like to be a memory shortage all the way through 2028, and then that's like assuming no delays, and there could be delays. One of the concerns I had personally for AI investment was the memory expense getting too high, where it starts to get to the point where hyperscalers start to say not worth it. So longer term, you do want memory prices to start to get curved. Otherwise, this starts to get bearish, not bullish, and it will be self-destructive to memory as well. But in the near term, the way we kind of view memory, the way we think about memory is that it has this structural tailwind embedded in it. And I think it's only going to get worse for the people who pay, and then better for the people who are selling, at least for the foreseeable future in through, beginning of 2027. And then how does that connect to hyperscalers besides them being the buyers? Well, it also means that the CapEx investments increasingly as a percentage are going to go towards memory. So while before it was dominated by other things, now memory is becoming increasingly a double-digit percent investment item, because right now, in order to power a lot of these models, in order to power a lot of the compute that's under demand, well, you need memory. Simple as that. And SanDisk, SK Hynix, etc., all of them have their different specific strengths. And specifically with SK, one of the things I like about them is that their memory, HMB or HBM memory, is much more important, much more critical for the components that are very critical for training and inference, the GPUs themselves. So if you look at what they've been doing as far as like deal flow with the likes of NVIDIA, they've shown to be a much more impactful, important player where NVIDIA wants to work with them over the others. And that's let's say that's not nothing to take note of. That's something, because while before it was much more regarded as a commodity, as there's no distinction between one versus the other, in these more advanced memory components, the differentiation is actually starting to show up finally, more technically, yes. And SK Hynix has illustrated this, I think, the best. But anyways, long story short, with memory, at least, I don't view it as like you hold it forever. You have to babysit the position, and you want to not, let's say, be too greedy with when you take profits. In fact, you want to probably, in my view, take profits earlier and don't regret it, because if you take profits too late, the downswing on these could be very violent. Those of you who've ever invested in memory, know this to be for certain. Now, going to the hyperscalers, we'll talk about Microsoft. So a lot of you asked about Microsoft. I'll bring up your questions on that, and I'll answer this question first because it's talking about Amazon, which is a hyperscaler, and then we'll get into the Microsoft specific questions. But I prefer Amazon because of my familiarity already with, after many years of becoming familiar with this business. I know the moving parts better than I do for Broadcom. And with Broadcom, while they have a lot of exposure to customized silicon and a bunch of other things too, they do have a lot of moving parts with them, because they've been very acquisitive over the many years. But I think retail investors think of them, they think of, Google TPUs and the like. But I think I'll stick to Amazon. For me, I think, what I like about Amazon, I have clarity on the three businesses that I love a lot. I think in retail, everyone knows they're dominant, but I think margins are going to continue to expand because of robotics and automation and those investments. I think that advertisement, which benefits from retail, will continue to grow like a monster and be this sort of like sleeper business that people don't pay attention to until suddenly it's a massive, massive portion of profit. And then, of course, AWS Cloud, which I think another, oddly misunderstood, because I would have thought by now everyone is on the same page here. I can't believe I'm hearing for the first time that Amazon is malinvesting. Amazon, they don't see the payoff for cloud investment, and I'm just like, this is crazy, because I understand if you said that back in like the early days of Amazon, but you can't say that in 2026. But there's people saying that. There's people saying I don't see the payoff for all this investment they're doing in compute, and I'm just sitting there. I can only be confused. I don't understand why someone could make that argument, but whatever. So between those two, I'll take Amazon, only because of my familiarity with it. But Broadcom, why not Nvidia is my question. And where are the questions? Thoughts on Microsoft? So let's talk about Microsoft. So Microsoft is now being viewed oddly as this AI loser. Now, there's a couple reasons for that. So one of the main reasons that I keep coming back to why people might be thinking this is the investment cycle for Microsoft has sort of shifted around a little bit, where people now think they're catching up, where they held back on some investments last year and are now paying the price in growth. So Azure, or cloud, I should say, coupled together, is only growing in the last quarter at 39%, when that was the expectation. If you're meeting expectations, you're a loser. And what probably would expect for the remainder of this year is to then meet expectations. Clearly, what I think Microsoft is showing that they're doing is managing the output of cloud growth, basically to hit expectations. Because they can grow at whatever they want. They're increasing capacity, and they're deciding how much capacity goes for internal usage or external usage. And in the case of Microsoft, every time they put more to internal usage, they put a deficit to the external usage, where otherwise would have increased the growth in cloud and monetization. And so the market's punishing them for that. Another component is that they're tied to OpenAI. So this OpenAI narrative that's very negative right now, strangely enough, is bogging down both Microsoft and Oracle. Now, with Microsoft, when they get brought up in conversation, again, sort of strangely now as the AI loser, OpenAI is also brought up in conversation as this company that's going to die. If you go on YouTube right now, there are endless videos about how OpenAI is a bankrupt company. Now, and in fact, after the news with Sora, after they closed down Sora, people say, you see, this is proof that they are a dying company, when in fact, all I see is a business that's being a bit more cost conscious on something that really wasn't going to be monetized in the first place. So the other point that Microsoft's kind of or the part that's like behind Microsoft that I think is to their benefit, or sorry, not to their benefit, sort of like a headwind, is this thought of like what's going to happen with their legacy software business. And everyone's calling them micro slop, right? Because they can't be innovative, on and on and on and on. And the software business, right? You talk about Microsoft 365. Oh, AI is just going to replicate this, replicate that, replicate Excel. When in fact, and the reality is, for many software applications, AI will almost be like this intermediary API that communicates information between softwares. But as a human utilizing all of these tools, you need a way to communicate to the AI in a manner that is easy to understand and practical. So that practicality comes from, okay, let's utilize the highways that we've already built. We don't have to recreate the highways. And in fact, there's a sense of efficiency too. So I was talking to, yesterday we had a great conversation. Shout out to Prisley again, where he brought up at his work where, he was testing things out in a personal / work environment, more personal, to try to see like the capabilities of these things. And one thing it had was like this API failed, and instead what the AI did was replicate the entire software layer that he was trying to get it to communicate with to then do a task. So the whole point of that story was to illustrate the complete inefficiency or loss or waste of energy that these AIs engaged in. And so something that you ask yourself as an investor, as an operator, we've already built the highway. Does the AI need to rebuild the highway in order to complete its function? Or can it just utilize the existing highway faster than a human and then give the output? And then the software is a layer by which the human can oversee the work of the AI and say, this was good, this was bad. So you always have that, check and balance. And then maybe in the farther future, there's no need because we trust it so much. But that's part of the conversation always with a lot of these software businesses. Are they going to get completely replaced, or are they going to just simply be this new interaction layer? And then the real question is, and does the charging system become more of like a seat or usage, which is where everyone's talking about going, more of a usage-based system rather than a seat-based system? And the other part that I think is more impactful is like AI's ability to empower enterprises, specifically companies like ServiceNow, Microsoft, Salesforce, all of these mega cap software businesses, that they're going to be able to produce a lot more software with their talent pool than before. And then this becomes very dangerous for everyone else who may not be as focused narrow. The converse thesis to that, or the converse opinion to that, is, well, it's actually going to make the smaller players more efficient. These are things we don't know yet. These are possibilities. It could be that Microsoft looks at their AI capabilities, right, or what AI enables them to do in the future, and they're able to suddenly create tons of new products and throw them out there and implement them. And the things that there were a lot of these other smaller companies latching on and putting on these services to supplement where Microsoft really wasn't focusing on, Microsoft can very easily spin them up and then start offering them directly. That's one future. The other future is, tons of small players start popping up everywhere that are all hyper competitive and start bringing down the cost of software. That's one future other people have discussed or envisioned. So, yeah, for ServiceNow, which has, in my view, a great culture and management team there. They're one of those. If that future is one that you think is going to happen, then ServiceNow looks to be probably a potential winner there. And ServiceNow and Salesforce are starting to compete against each other. But I can tell you with confidence that Salesforce stepping into ServiceNow territory versus the other way around, it's much easier for ServiceNow to do that than for Salesforce to step into ServiceNow's territory. So watch out for that. But AI could actually boost a lot of these businesses' capabilities on creating and replicating various product offerings. So Microsoft, to answer the question, thoughts on Microsoft here. I like it here. I think now you're getting it at close to a peg of 1 for a business that's probably, you could argue very easily, is the greatest or one of the greatest businesses on the planet. I think that their death is greatly exaggerated. Them being called Microslop on YouTube only makes me more bullish, because when the normies get very bearish something, that's typically not a bad sign. And I think that them being dismissed as an AI winner at all is a bit premature. The sentiment, though, and I'll shout out to, I can't mention them by name, actually. So respect that I can't mention them by name. But shout out to one person who was expressing caution and said, this is a wait. Trust me, the sentiment will get worse. It looks like the sentiment has gotten a lot worse over time. And, we're sitting here having this conversation at $371 a share, and that it could continue to get worse, but it's only trading at 23 times earnings. And I believe that's trailing, not forward. And then at forward, ending for December, it's probably somewhere under 20. Their full year ends in the summer. So we'll see what their guidance for CapEx is. And then if you look at historical multiples, they are replicating or echoing that of what we saw in 2022. From a free cash flow multiple, that's going to be, I think John said it was like 30% lower from here. which is not impossible, but that's a bit more extreme. And in fact, considering the fact that, we're also talking about CapEx being as high as it is now compared to before, that's also quite impressive. So, what are my current thoughts on Oracle? So I like Oracle because of how much of a battleground. So like my hesitation with Oracle is what Larry Ellison is doing with his collateral and this Warner Brothers Paramount deal. That's my only real concern. But like the business itself, I think will be fine. I think it's overly hated. And if again, tied to like this OpenAI calling bullshit on their RPOs and all that. But I tend to feel positive on Oracle. I don't have a current position, but it's one that I'm kind of like still, even though I did participate in the shares briefly. I'm like a sideline cheerleader for it. I'm not looking to buy back in Oracle, but because frankly I'm so focused elsewhere, which we'll get to some of those stocks here. But Oracle's been one that's like, I see it. I'm on the side of the Bulls, but I'm not, in the trenches with the Bulls just yet. I'm cheering you guys on. So, but I do think positively. I think if the OpenAI hate dies down and people start proving the RPOs are in fact real, which I think they've already done in my view, but like still more, the market needs more. And if they show up to be very real in the let's say 2 to 3 years from now, the stock's going to be materially higher than it is today. We're talking probably easily over $1 trillion market cap, for sure. So. Fiserv. Okay, frankly, because of the price change, Fiserv can be probably interesting to look at. But the thing is, it's trading at single digits with tons of leverage, and I got a fintech that's single digits, growing at 30 to 40% with not a lot of leverage. You know what I mean? Wink, wink, nudge, nudge. Like that's often the problem. And Fiserv's position, especially with the core banking business, is more defensible. I'd say I trust Fidelity's management more than Fiserv's, because Fiserv's just has a lot of hair on it, and I think the market's going to remember that for a long time. I could be wrong, but I listened to a few fund interviews, and a lot of them sold on that announcement. And I don't think those guys, which usually are the guys that you'd think are going to buy stocks like that, are going to be buyers anytime soon. I think they're going to step away from that name for a while, at least. So, yeah. But yeah, Fidelity's business, a lot more defensible. Their merger, kind of weird merger with like WorldPay, and what they're doing there, kind of divesting assets and then taking on some assets and focusing on their core business and divesting the merchant solutions business, I think is a good move because it keeps them focused and grounded. Them focusing on more the larger banking partners in the core business is good. So I think it's a lot easier to understand Fidelity's business. Fiserv's business, the core business, good, but the merchant solutions business is a bit murky. They're competing against the likes of Toast, which I saw a question on Toast. I do like Toast a lot. I find that the management team there very focused, very in tune with what the customer wants. And I think they're set to dominate the restaurant category and then the hospitality category. So when I put them side by side, it's like Toast is better than them in every single way for Clover. And then if I want another fintech that's also not that expensive and also really good, is Square. Square is like, well, Jack Dorsey doesn't give a shit about his shareholders half the time. And recall, we didn't do a live stream when this happened, but when Square cut their workforce and said it was AI, that's all bullshit, by the way. My partner, Michael, who you should follow him on X, Barnacle Taint Pipe. I know, funny name. Haha, get it out of you. Laugh a little bit. But he's been kind of calling out that Square's reputation within the industry. And by the way, Jack Dorsey responded to him. That's much traction he got. But Jack Dorsey responds to his tweet saying, "Oh, that's not true," blah blah blah, because it's been called out. It's been known within the industry, within the fintech industry at least, that Square has been a place like a retirement home. They hired way too many people. They don't like to let go of anyone, and these efficiency moves is finally happening. So it was always needed to occur to get the business back on track. But the core assets, pretty good. You got Cash App, phenomenal asset. You got the merchant solutions, phenomenal asset. You got this like random ownership and title that I'm pretty sure was just to get close to Jay-Z. It was like a vanity purchase for Jack Dorsey. But other than that, I mean, like you got great assets. You got a lot of potential there. Jack Dorsey is very good at products. That's what his brain's really good at. His brain's not really in it for, maximum efficiency, but he's great at designing and launching products. He's great at that. No one can deny that. But what he's not good at, outside looking in, and again, by the way, super accomplished guy, more power to him, multi-billionaire, right? He's made it, right? Who are we to criticize him for his business acumen? But my opinion, just outsider looking in, and also my partner Michael's, he's kind of looking at it and saying like, well, there's a lot obviously that could be done. There's a lot of low hanging fruit they could have tackled a while ago. They are doing it now, and there's speculation as to why that might be happening now all of a sudden. But that it's AI, doubt. They're not letting go of that much people because of AI. That's just because they were extremely bloated enterprise. Everyone was saying it. Most of fintech went through the de-bloat phase back in 2022. Most fintech went through the efficiency phase, and Square didn't. They're just catching up. So that's a little tidbit. But that's, honestly why you say Fidelity or Fiserv, like, bro, you got Square, which honestly, XYZ, not that expensive, right? Not that expensive for the growth you're getting on a forward basis, by the way. Trailing is like whatever. But on a forward basis, and you're going to get a lot of those efficiency gains here soon. Great assets. You got, heck, I'll even say Hood, which is a high beta stock. Right now, I mean, the story behind Robinhood is still one of in the asset gathering phase. And I'm telling you, they're going to monetize that cohort like crazy. So within the United States, for example, there's a lot of people within the group that are 1 million to 5 million AUM, or not AUM, sorry, net worth. That cohort, believe it or not, is a bit missed by the Schwabs, the Merrills, the JPMs. They have something for them, but they don't have the good stuff until you have a lot of money. It's like, for example, Merrill doesn't give you the really good stuff starting until 10 million, and then doesn't give you the really, really good stuff until like 100 million, as an example. So Robinhood, as far as like their strategy goes, they're going to try to tackle the 1 million to 5 million and the people they think that are going to get to that cohort a lot. And that is evident by a lot of the new product launches, the wealth management solutions, the platinum card, whatever you want to say about it compared to other products that exist out there is okay, whatever. We can get into the nitty gritty about it. But I'm telling you from a high level, what the business is focusing on, what they're thinking about, is that they're trying to target that I know it's like crazy to say, but underserved cohort, and it's working. Them offering the matches is working for people who have $1 million in treasuries, right, or whatever, and you want to park it at Robinhood. Who cares if they don't have the most available shares of globally? Who cares about that? You're literally parking it in treasuries. Just throw it in Robinhood and get the match or whatever. Or you're an index fund investor. You have all of it in S&P 500 and total market and total world, whatever it is, you have it in. Yeah, throw it in there. You get your match and whatever. So that's their strategy. They're in the asset gathering strategy. They're at 300 some odd billion AUM. Or assets under custody, not assets under management, assets under custody, for those of you who are going to be like all technical with me. And as far as like comparing it to Charles Schwab is like much, much, much further along. But don't you wait. Robinhood's going to get there. But they're going to do better than all of them is the monetization aspect, because that's what their team is really good at. Their team is excellent at figuring out what can we introduce, How can we introduce it? Let's get it into the market. And if I'm being honest, and this is something that, again, I know through the people I've spoken to in the fintech space, they have become this sort of like gold standard, at least in UI and design. So like when people say like, oh, how are we going to design our UI? Make it like Robinhood, right? Why make it like Robinhood? Well, no one could deny that their UI is impeccable compared to everyone else out there on the market. So yeah, that's what I have to say about Robinhood. So when you have all these other fintech options like Fiserv, Fidelity, you're kind of just like going for the low PE stuff, not growing much, and you got all this other stuff. And Dave, speaking of, full disclosure, full disclosure, long hood, Dave, I mean, this thing's growing at 40 to 30%, or 30 to 40%, wrong order, I did that, and trading at, and I know it says they're 14 times earnings, it's actually trading at single digits, or close to single digits at this point. And again, if you're measuring it on a peg, insane. I recommend just go listen to the interview if you want to hear from the management team and some of the questions we outlined. And I think you'll enjoy it if you're curious about this business. But there's a lot of misconceptions about Dave as an enterprise that will eventually get churned through the system. But in the meantime, I'm happy that it's like kind of funnily a battleground stock at still higher highs than what it was before. But it is what it is. It's trading mostly like today, no news. A lot of stocks in this space fell. Sezzle fell. A few of the other ones that are kind of perceived the lenders to poor people or whatever, they fell. And I viewed it as strictly a buying opportunity. For me personally, not concerned at all. Now, buyer beware on the volatility. What you do have, again, is the business is a buyer of their own stock. Again, I'm going to highlight one more time. I am long the stock, so I'm biased in everything I say. So you can throw everything I say out the window if you're like, oh yeah, bias, he owns the stock. But in my view, in my opinion, the stock is trading at a very cheap level. And what I like about what the management team is doing right now is repurchasing stock. If I view the stock as underpriced, I want the management team, I want the company to be buying back stock. Now, there was a great question on insider selling, etc. Now, insiders sell for a multitude of reasons. They sell for tax purposes. They sell for diversification purposes. Keep in mind the CEO owns, and part of his net worth is tremendously invested in Dave. He saw his net worth go to a much smaller. Like at one point, Dave was trading at $100 million market cap. Just FYI, like if you zoom out. And by the way, this is kind of the story of Dave. Dave first IPO'd as a SPAC, so they SPAC'd or de-SPAC'd is the more proper way of saying it. And then the fintech Armageddon, yada yada. Have the old adage of like be very careful when things first IPO, let things kind of go through. And the valuation was out of this world. Good for them in that case. In the very beginning, de-SPACing at that valuation and getting those warrants may never get exercised, thankfully. But the business model has also changed drastically from what it originally was. So funny enough, in order to appease to regulators a bit more, their business model converted to something that's far more profitable, where before it was much more donations based, or tip based, I should say. And they got rid of that in order for more guaranteed and firm monetization, which that's the actual reason for this massive jump up here in 2025, was the business model change was actually extremely positive catalyst. So now we see where we are today, and the business is still chucking along with new products coming on the horizon, particularly buy now, pay later, which is going to be a lot more impactful to Sezzle. So when we see them going after the Sezzle customer, that's going to be really interesting as far as a monetization standpoint and what that's going to do as a driver of earnings. But Dave, as what they are today, in terms of earnings power and growth prospects, well, you got the growth, you got the earnings power. You got the delinquency rate figure, which is basically like a lever they can pull and like how high and how low they want to go. When you see a little bit higher delinquency rate, what we saw Q3 of last year, if you understand how this business works, a lot of that is like their think of it almost like marketing spend. So they take on a little bit higher delinquency in order to reach newer and newer customers, so more and more customers, and then they can become more strict when needed and become more loose when needed. And still, delinquency rate, 2% when it was in that panic mode. I think it's 2 point something percent, and then now it's at 1.9 to 1.7%. I'll give a range because I don't have it in front of me right now. But point is, fairly low. And this misconception about lending to people who are let's say not as well off as like, okay, that's just a horrible product or whatever. It is what it is. So something they may not overcome in the near term, but in the meantime, lots of buybacks. They even borrowed money at a lower interest rate than treasuries to buy back stock. I can go through the function of how that happens if anyone's curious, but I'll just leave it at that for now. But that's another part that's like, okay, kudos to the management team for taking advantage of that. Okay, so enough of that. But that's like an example of, or I just gave you a bunch of examples of fintechs trading at relatively cheap levels. And, by comparison to the ones you named, it's like I can't even justify even thinking about those more challenged, more levered businesses when there's things like this, things like I just mentioned, XYZ, even Toast, Mercado Libre, if you want to count that also, because that has a fintech branch on it. Affirm even. So there's a lot of things out there. It's like, why would I bother? So at this price, the risk always is regulation. That there's always a risk of regulation. In conversations, right, we talk about this, and you can never get rid of this risk. The risk is always going to be present, but the risk is always present for many industries, as far as like regulation goes. But it's not, at the very least, it is not a recession. That's not the risk with Dave. In fact, when we spoke with management, we asked that question. I think you heard it from the horse's mouth, but I'll say it again and maybe explain it better. In let's say within this context, this is much more like a question of TAM expansion in the moment where we see some sort of like difficulty with larger and larger percentage of the population. So if we do see people who, let's say, go on more unemployment, Dave management team pointed out, they'll just underwrite the unemployment cash flow, because it's all really about underwriting cash flow, whether it's from your income, salary, unemployment checks, whatever it might be. And at the end of the day, this is like a solution that is superior to a lot of the existing and legacy solutions that were much more harsh on folks who go through a tougher time. And the underbankedness of this cohort of consumers and is notable, where the point where this buy now pay later solution, when it comes later this year, which I think they're going to start launching next quarter, at least we're going to hear about it for the first time, is going to be that part of like monetizing the actual consumption of these consumers who, again, underbanked. And just because they make less money doesn't mean they're underwritable. They can be. There's a lot of people who make less money but are good for it. They have like a tendency to pay back what it is that they borrow. And recall, these are small loans. Like for someone who's investing in the stock market, you're already in the cohort that's probably not in the customer cohort of Dave. So at least not yet. I don't know about in the farther flung future what they get into. And it's a business that's extremely efficient. Like we said, they have just like 300 employees. And every time when they pull this lever on growth, it's just like they don't need a proportionate amount of employees more to grow. So as far as like an efficiency level to measure on the business, it's fairly high. So yeah, within the realm of fintechs, this is a very attractive business. in the realm of fintechs? Is it are fintechs the most attractive business sector ever? That's a separate question. But yeah, within the realm of fintechs, this is one of the more attractive ones. Oh my gosh, is that you, EJ? Like EJ from CM? Is this you? You just EJ everywhere? Because you have the little symbol there. I don't know. Maybe you're just another EJ, but are you EJ? If you're just another EJ, because EJ might be a popular name, because we have there's an EJ I always talk to in CM. So I don't know if it's you or someone else. I've never seen you on YouTube. Oh my gosh. Are you flirting with me, James? No one calls me Fabi. I'm a different Stabulo. Fabi happy. Okay, so what I think about KKR at today's price. You got caught, EJ. And great questions, both of these on this. Right, it's full of discussion about how to revoke ACH from Dave after borrowing. Yes, because they attempt to do it, but yeah, they're not very successful at it. And of course, those are the customers at the end of the day you don't want. You want to hot potato them, where if you make it difficult for them to do it to you, you want them to use your competitors, because lending is a game of hot potato, where if you get all the good ones and then you give your competitors all the bad ones, leave them the bad ones and keep all the good ones, you're good to go. So, but anyways, coming back to these two questions. So what I think about KKR. Oh, I like KKR here. So I've been looking a lot more into all of the private equity firms, in particular after the sell-off, and I think I came to the conclusion that for me, my fair value estimate for KKR happens to actually be around the $150 range. And with KKR, you get a much more dispersed exposure to private equity. You get real estate infra, you get private credit, and then you also get traditional buyout private equity. So KKR is multiple here. Honestly, extremely attractive. All of them really, but mostly KKR and Apollo are the ones I think of when I get really excited here. So from a distributable earnings multiple, they haven't been this low in a very long time. Taking a look at what the previous lows were back in 2022, we saw lots of news about the redemption notices for the B REIT, for Blackstone, for example. So this could probably mark down the lows for KKR and the others, which would be very interesting. So, but I'm a buyer here of KKR. I think KKR, Apollo, and the like. If you're trying to bet against this whole private credit scare narrative, I think is worth it. Now let's talk about this other second question. So do you think the private credit bubble is as bad as they say it is? No, I do not. I do think there's some bad actors out there, but I don't think it's as bad as people say it is. Now, the problem with private credit is its lack of transparency that you get with some of the banks, because with more like public credit assets. And that has a lot to do with, the nature of it being private, right? So it's kind of like an unfair, let's say, it's not an unfair comparison, but by the nature of it being private, it inherently will be opaque. That doesn't necessarily mean it's bad. It does, from the liquidity standpoint, it makes a lot of sense why you get this like denial of withdrawals. So all these people that are trying to withdraw, when you engage in private credit, when you engage in these investments, you are told that there's these blockages where, let's say these redemption gates, or after, let's say 5%, no one else can withdraw, because there's a liquidity problem with private assets. And so everyone who's getting involved right now or was getting involved with it and is suddenly starting to rush to the door to redeem, and they're getting shocked that they're only not allowing 5%. Well, of course. And the whole point of getting extra yield in the private markets is you're sacrificing duration. Credit, there's no free lunch. The credit markets are fairly efficient. If you're getting higher yield, it's because you're getting compensated for some reason. You're taking some other form of risk, and there's different kinds of risk. There's credit risk, right? So you're taking on greater credit risk. So you're lending money to AMC theaters, or there's liquidity risk, private credit. So credit that will be less liquid. So what is your reward for taking on that risk? Higher yield, higher potential return. Go figure, because liquidity is a risk. Because if you're an entity that needs instant liquidity, then in that case, you're going to pay a premium for the types of assets you're going to hold. So, an example, the greatest, most liquid asset on the planet is US Treasuries. It's effectively dollars that pay something, dollars that pay yield. So if you want the most liquid asset on the planet, guess what your reward's going to be? Zilch for holding it. It's going to be very little. Go figure, because you're taking on the risk-free rate. You're taking on risk-free, and you're not taking on any risk. And if you take on private loans that need to be sold to someone else in the private markets, there's risk there, liquidity risk. So you'll get rewarded for that. So forget about just the credit risk, because there's credit risk and liquidity risk. And private credit, if private credit blows up, all of private equity really blows up at that point, because like credit is lower on the risk curve than equity. And if you're worried about private credit, you should be horrified about PE. But yet institutional investors, especially the ones that are like saying, oh, no, I want less exposure to private credit, I want more exposure to PE, because that's happening, by the way. That makes almost no sense, because you can't hold the opinion of, private equity is fine. So buying equity stakes in businesses is fine, but buying the credit is bad. So it's kind of like a strange psychosis. And anyways, talking good about Apollo briefly. So if we look at Tricolor and what happened last year, remember that they shorted the debt. So it's kind of funny that you had actual banks, JP Morgan, involved in the credit on the long side. Of course, it was nothing to them, but they were involved in the long side of a lot of these frauds, right? Two of them. And the ones who were betting against it were private credit firms like Apollo and Oaktree. So, that's the irony of it all. Because those are the champions, right? So when someone thinks of private credit, they tend to think of Ares and Apollo, and all the major ones have their own private credit arms. But you would think, oh yeah, you read the headline, you're like, oh, private credit worries, and it's like, oh, they must have got caught with their pants off. And you read further, and you're like, wait, what? Apollo shorted the debt, so Apollo made money from their bankruptcy. Oh, maybe the private credit managers aren't that bad after all. Yeah, maybe not. So anyways, going through. Scott's thoughts on Reddit. Not lots of monetization potential on Reddit. Other ads based platforms that I like is like AppLovin. I like AppLovin. So Meta, obviously, but then AppLovin's really good. Reddit has a lot of potential. It's the year of REITs only when long-term rates go down. If they don't go down, you don't have the year of REITs. Too complex for my liking, Shift 4, but screen's cheap. So Blue Owl is the ugly duckling, Sam. Yeah, Blue Owl is, so if you're looking at Blue Owl, that one, in my view, is the ugly duckling of the bunch. The ones I'd stick to, if you're interested in private equity, is Ares. So this is how I'd break it down. Ares is the simplest from fee-based related earnings. So FRE, fee-related earnings, Ares is the go-to. Nearly all of it is going to be derived from that. If you're looking for more a mix of spread and fee-related earnings, the biggest mix you have is Apollo. So Apollo has Athene, which is the largest life insurance business of the bunch. So they own the largest section, or sorry, not largest section, largest entity. So through Athene, they're generating a lot of spread-related earnings, and then through their traditional private equity, the fee-related earnings. So you get a mix of both. If you want like the broadest diversification across asset class, but still focused on fee-related earnings, you have Blackstone. If you want a mix of the insurance, so spread-related earnings, but mostly tilted towards fee-related earnings and the diversity of Blackstone and the on-balance sheet businesses, you have KKR. If you want the highest risk, most questionable portfolio, you got Blue Owl. That may end up not being fine in the end after all. Who knows? So if you want secondaries exposure, you have Stepstone, you have Hamilton Lane. Those will give you great secondaries exposure. Carlisle is also fine. TPG is going to give you, again, more spread-related earnings. Sorry, not spread, fee-related earnings, much more buyout focus, starting to get into private credit, and getting into the spread-related earnings eventually, potentially through Jackson Financial. But yeah, that's those are the ones I'd go for if I was, gun to my head, like picking one. I'd be focusing on looking at Apollo, KKR, Blackstone, Ares. And then if I was curious about secondaries, Hamilton Lane, Stepstone. No thoughts on the trade desk. Looking at the trade desk, there's a lot of people who know more than me that are telling me to stay away from that. And there's other things I understand better that I can focus on. Yeah, so hope I answered this question already, Citizen of the Year, but no, so like private credit putting limits in place, those limits are predetermined. It's a feature of the product, not a bug. So it's already built into the agreement. Like when you invest in private credit, you are told upfront that there's a limit to how much can be withdrawn because of the liquidity. They are not sold in the open market. You cannot just click a button and sell private credit loans. You got to find a buyer. So yeah, not a problem by itself. Okay, so great question, Shaps. Would you rank risk reward levels Amazon, Microsoft, Meta, Google? So Google, I'd actually put closer to the higher point because of valuation. I know it's come down now; it's at 290, but I put it at the higher point of risk because of valuation and given what's starting to happen with ChatGPT monetization and ads. Everyone dismisses this, but you shouldn't dismiss it. They have 900 million and growing weekly active users, and up until now have not been monetizable on an ads basis, but now they will be. So we don't know what's going to come about from that. Amazon, I think, is really well suited. It's kind of been crunching up in its multiple. So I'm biased in saying I really like that one. Microsoft is getting much more interesting each and every day that it continues to slowly grind away and decline. And then Meta is finally back to a valuation that's under 20 times earnings, right? Forward earnings. So Meta's sell side guidance looks like it's abysmal. They're almost implying zero growth for this year, but I doubt that happens at all. And Meta looks like they'd be having a lot more focus on costs and more focusing on growth investments. So a lot of people dispel this like doom and gloom because of what they spend on Reality Labs, but I'm just like, it's fine because you cannot know. You want them to engage in like alternative projects because you never know what's going to come about from them, and people kind of have been spreading false information about what it is that they're closing, what it is that they're not. They're taking away some capital from that investments on an annual basis. But in terms of how much annual spend that's still going to be there, it's like the equivalent of many companies' entire revenue streams. So it's not nothing. And you don't know what's going to come about that in the future. People talking a little bit too soon on what Mark Zuckerberg likes to do, and people saying they can run Meta better than Mark Zuckerberg. Give me a break. So, I think Meta has a lot of potential from this current valuation, and you know that's after it's of course ran from where it has in lows of 2022. So yeah, ranking them probably I'd say somewhere Amazon having the clearest like long-term wins under its belt, Microsoft right there, Meta, then Google is based off current valuations. Oh, I think I've heard of Partners Group. Aren't they like don't they do more European real estate? I forget. Great manager. The local, I prefer Adyen, but hey, you know, overall, it looks cheap. Screen's cheap. LNG versus VG. In general, natural gas might be due for a pullback, especially if something happens, because like it's getting ahead of itself in terms of you know, ahead of like what's going on with like the distribution. Because we can't really export this too much. I'd probably actually look at some of the pipelines, like I think it's a Tagra. That one seems like it's going to be still a long-term winner. PAGs, no, I don't have anything about PAGs. Okay, egg. I'm just trying to go through this. Egg yield. So eggs, yeah, Vital Farms and Cal-Maine on a sell-off look pretty good, look cheap. Vital Farms might have some branding issues right now, but you know, Screen's cheap. Egg prices are probably not going to get much lower from here. Cal-Maine, no debt. Well, both of them, no debt, lots of cash. Both of them doing buybacks. Yeah, probably is an ad. Oh yeah, LVMH. Yeah, well, LVMH caters much more towards upper middle class, so a bit more cyclical than something like a Hermes. If all else being equal, if you see Hermes keep selling off like it is, I'd pick up Hermes. I think Hermes is completely immune from economic downturns because of its clientele. LVMH is more aspirational luxury, not so much true luxury. Their focus is aspirational luxury. So, you know, if you look at every single one of their brands, I'd classify the vast majority of them as aspirational luxury. By the way, when I say those things, I want to clarify that is no comment on quality, because the quality, like, heck, you know, it's like I have, you know, it's not because I have a little wallet from Louis Vuitton, and it's like, it's not, when I call it aspirational luxury, just because it's not Hermes does not mean it's like bad quality. It's a good quality product. It's going to last a long time. So I'm not shaming anyone for buying LVMH over Hermes. Buy what you like. But because I want to clarify, because some people may, you know, they're like, oh, that's a snobbish comment. But no. But Hermes is in a class of its own in terms of like who buys it and how are they affected by broader economy. And there's a lot of brands that are like that. If you find them, and you'll see like they just decide how much money they want to make every year. LVMH though is going to be more tied to how people feel. So that upper middle class consumer, if they pull back, and that's, by the way, per their own arguments, they say that, right? They say they target the upper middle class. So yeah. It's LVMH's CEO keeps texting me, telling me to buy. He has been buying at these levels. So SaaS stocks, a good contrarian long play here. Yeah, I think so. I like the names. So this are the criteria that I told people in the Capital Mindset Club, like as far as the way I'm thinking about SaaS. So you're going to get me on a rant. I love questions that get me on a rant. So we're going to go. So there's software stocks like Adobe, right? So Adobe is one that the growth has tempered. And what the problem with the market, right, is the market cares about growth. The market does care about the valuation on a relative to growth basis. So if the growth has been coming down, right, for something like an Adobe, the market's going to get concerned. The market's going to look forward and say, okay, what is the forward growth going to look like? What is their TAM doing? If that's coming down, the market's going to be concerned by it. With Adobe, you're getting a business that trades at, by the way, on a GAAP basis, you see it's like right there about 13, 14 times earnings. And so it's still not at a peg of 1. For some of these other businesses, they are trading at a peg of 1 or below, and they are SaaS. Adobe, the question the market's having is like, okay, the growth is slowing down from where it used to be mid-teens to now, including buybacks, about 12%, and then excluding buybacks, low double digits, high single digits. And then the market's like, well, what's going to happen after that? Is it going to continue to slowly decelerate? Because what actually is happening with Adobe is they're seeing a lot of pressure from the amateur market, which if you guys have been invested in the markets for a long time, I mean, I don't know, you need to be reminded, like the growth story from Adobe, what they used to be pitching to shareholders, what the CEO would go on Jim Cramer back in 2019 or so and talk to Jim Cramer about the creator economy, because that's what their growth story was about. It was about growing in the amateur market. So someone like me, I'm an amateur, but by the way, fun fact about me, when I do videos, I do one take. If I mess up, I restart. But when you watch a video from me, just like a live stream, it's all one take. I don't really care to do the whole editing game. I just want to sit down in front of the computer, hit record, talk, and then put it out there. I think about what I'm going to say beforehand. And then if I mess up, I just, well, fuck it, start all over. But I'm the amateur, and I use Canva for thumbnails because it's like super easy. I just go pop, 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 and done. I don't need Photoshop. I don't need all the bells and whistles that Photoshop offers. So in that aspect, they've been suffering because the amateur market, not the professional market, has had a lot of new entrants. And artificial intelligence right now is much more of a threat in the amateur, especially amateur professional adjacent market. Not so much in the professional market. So anyone who says like, oh, the professional market's under threat, no, that's not true. And I don't think the market thinks that either. If the market thought that, by the way, Adobe would trade at like single digits tomorrow. If the market really thought that there was a threat to the professional market, you would not trade at a peg above 1. I can tell you that right now. You would trade at a peg below 1 because the market is implying contraction at that point. So the market's not implying contraction. The market is implying growth opportunity decline. That's it. And that's always been the story. So beyond like trades here on sentiment with Adobe, I've been cautious about it. And I've had this rant multiple times with members in the club on Adobe, that because I get asked it a lot because it's talked about a lot on YouTube. But yeah, it's not a bad business. No one ever says it's a bad business. All that's happening is the growth potential for Adobe has been put under question. And if you get it under a peg of 1, so like let's say if it starts to trade, I think you did the math. It's like it trades at 180 times, or sorry, not 180 times, $180 or so. I think that puts it at around 10 times earnings, which puts it at just about a peg of 1 or below. And so at that point, if you think growth is relatively stable, it becomes a very interesting value proposition because you also want to include some margin of safety, right? Otherwise, if you buy on, like where it was relative to the price of a few years ago, then you're just kind of anchored to a price and you're assuming multiple expansion to some crazy degree. Because, kind of a simple, really simple, crude thought exercise. You take an investment and you buy it at 10 times earnings. You're going to grow at whatever percent, right? Let's just keep it simple. Say 12% or 10%. And let's not worry about the terminal growth rate. Let's put the terminal growth rate at like GDP, right? So when we're doing our valuation. So if you're just not worrying about discount rates real quick, just keeping it super simple and just use multiples. So you can think of sometimes as like the potential return, multiple maintenance with the factor of the growth rate. So, if the multiple maintains itself at 10 times and it grow at 12% or 10%, that's going to be relatively return. Then market never does that, but just like in this illustrative high level exercise, or not high level, that's the right word for it, high level exercise. We're going to think about it that way. So that's more or less like where you want to start thinking about your setups. And right now it's trading at 14 times earnings. So does your thesis rely on multiple expansion? Yes or no? And you have to give me a reason for it, because it can be that the multiple will expand, but why? And you may be right, you may be wrong, but at least, think of a reason why it would expand. Why would someone pay 20 times earnings? Because if that happens, yeah, you're going to have pretty good returns here, because, you're going to get 10%, 12% with buybacks, maybe a little bit more as if the price keeps coming down, maybe 14% return growth in earnings per share. And then why would the market pay 20 times earnings? If there's like a reason for it, if like growth reaccelerates and that's going to happen, yeah, it's a buy here. You buy Adobe hand over fist and you're going to get a decent return. But if that doesn't happen, I'm just telling you what the market's thinking. All right. So every day Adobe goes down, starts to get more and more interesting. The conversation that bears might be having is like still its effects on, or AI's effects on the forward growth potential. But that's the debate to be had. Then there's other software companies that are less of a debate whether or not they're going to be affected by AI. So you take ServiceNow, you take Salesforce, yada, yada, yada. And some of these like Salesforce, the question is more like the transition from seat-based to usage-based. ServiceNow, something similar is being had, and like how that transition starts to look like. That's what's a little bit scary. So going back to like the framework that I think about software is I try to look for high visibility, extreme penetration, and moat. So easier said than done, but I'll give you an example. One that, a lot of people are going to go ick at, but Axon is, I think, a great example of that, where they have extreme visibility in their revenue streams. There is a lot of, or there's a lack of disruption in the seat-based model there, because the officer unit, the person, is something that, you need a physical person to occupy that space to enforce law. And so the seats, you don't really reduce the seat count there. So that's just an illustrative example of like the characteristics you might want to be looking out for when it comes to SaaS and what you're trying to invest in. And Axon is not the only one out there, but I'll use just that one as an example, and we'll move on from there. Okay, somebody wants to report on SoFi. Okay, yeah, we can talk about this. So Adobe dead. No, Adobe is not dead, but Adobe is, the market was just simply, and I said this actually in the last live stream back in January, the market is just questioning the growth potential ahead for Adobe. If it was thinking it's dead, you would see it at single digits. I know a lot of software companies that trade at single digits. Companies some people might not even heard of. Just buy Coke and chill. Hell yeah. I love Coke, the bottler. That's God's company. If you know, but that's God's company. I'll give you another one that was a nice pickup. VeriSign. So VeriSign's another monopoly, but yeah, VeriSign and chill could be something to look at. Well, let's talk about muddy waters. Do I have any thoughts on Roblox? Wait. Actually, we're going to spend about 30 or so minutes on Roblox. All right. Anyways, coming back to this. Oh, we'll talk about this. Yeah. Hello, my fellow. Well, I'm not a Euro right now, but hello, my Euro. Yeah, go to Colombia for that. All right. So going back to this question. So what are your thoughts on the Muddy Waters report on SoFi? Have you warmed up to SoFi yet, or still not a good investment? No. Okay. So you didn't see my updates last year for sure. Or was it 2024? I did a stream a long time ago now, and have repeated when people have asked me, but don't worry, because I know there's like a lot of content. So I am not a SoFi hater, so to speak. In fact, because like within my partnership, Michael, who's our fintech guy, He actually comes from the fintech space. He's educated me a lot more on the fintech landscape, and so I don't view SoFi as a bad investment. Now he gives me the credit only in that the bulls make it almost hard to be bullish SoFi, because the bulls are bullish for almost like the wrong reasons. But SoFi as a business, in fact, is potentially something that will be a longer term winner in the future. Now, does the valuation make sense? That's a separate question. Does the opportunity set make sense relative to everything else? Separate question. In our argument, no. And on a relative basis, but as an isolated case, like if you own SoFi from like the $5, you're fine. I think you'll do fine. I think SoFi will do well as a business, continue to compound, continue to take share. And there's a lot of monetization efforts they can do to get more from their customers, offer more to their customers. So, it's a great platform. I changed my mind and I admitted that I was wrong on that. So those are my updates on the Muddy Waters portion. Muddy Waters has a muddy history, so to speak, pun intended. So there was a stock that I was long last year and recently had taken profits and have re-entered, being FTAI. So they had made a lot of claims against FTAI. They made a lot of claims against ELF. They've done short reports on. I'm trying to remember. There's one more. But anyways, they've made some short reports on a variety of companies that a lot of them turned out to be questionable. So with FTAI, which I'll show you when their short report came out and why in Capital Mindset, the folks that were in on this, we were buying this hand over fist. And it was, I think, around here was the short report back in February. And so anyways, so they come out with this short report. It's not even originated from them, by the way. So you have to check if the SoFi one is also originated from them or if it's like given to them by someone else and they're like reposting it. But actually we'll do the candles because yeah, like right around there was like the short report, if I remember correctly, or here, February. I think it was here in February. I could be mistaken, or it could be on this one right here, the January. Point is, beginning of 2025, Muddy Waters short report comes out. Now, don't use the stock price to say, oh yeah, they were wrong, because the stock price is materially higher, although I will point out it is materially higher. But there was a lot of claims made from the accounting standpoint of FTI saying that, oh, they're doing this, they're doing that, they're manipulating things, yada, yada, yada. They even brought on a former executive who didn't really say much when you read their statements. They just said, yeah, they did this one transition of the asset so they could get maybe a higher multiple on their stock because the market rewards more the MRO business than it does the leasing business. And it's like, okay, like, yeah, but nothing too critical. So when I brushed over the SoFi thing, I have a hard time reading it almost from like an unbiased angle because I'm familiar with Muddy Waters' work, and Muddy Waters used to be really solid work, especially when they covered Chinese scam codes. And then they kind of started to utilize their fame, their reputation, maybe a bit harshly on US companies for profit. So that's like where sometimes when I read their reports, it's like I have a hard time reading it with an unbiased lens of already sort of dismissing it. But when I didn't read it in detail, I'll be honest, but skimmed through their SoFi report, the claims they made about their loss rates, if true, SoFi is an easy short. Like SoFi is an obvious short, but I just don't think it's true because I've seen them get things wrong, so wrong before. So if it's wrong, SoFi is a buy. Is it a buy relative to other things? It's like the question that I keep getting back to. And probably not. But as a business by itself in isolation, yeah, it's probably a buy. It's probably a buy. So don't really like Muddy Waters' reports. No. No, it is an attractive sector. I'm saying some people might argue it's not an attractive sector. I think it's an attractive sector. I think it can be, and it comes in and out of favor. Right now, fintechs are out of favor. It all started when, well, last year they started to come out of favor after the summer, but it really hit hard when the president invoked a suggestion of a 10% cap on interest rates. That's when things went fucking crazy. What is this capital mindset that you speak of? I like Palo Alto, prefer Fortinet's culture on internal production of new products and their use of shares being much more recluse and buybacks. So that's what I'll say about Palo Alto. Like it. I hate it. But to answer your other question, like fintechs, I think is an attractive sector. I think other attractive sectors, include broadly speaking, hyperscalers tech, advertisement tech, things like that, high margin, high scalable businesses. I do also find in various industrial parts like GEV Vernova was another one we were long. We're no longer long, but we were long that. And structurally, that was a fairly easy theme to kind of follow through, the energy constraint capacity. Cyclicals in like, or commodities, sorry, I won't say are attractive, but they go through their cycles of when they, kick ass and then when they don't kick ass. You're loading up on Newell Brands. Well, geez, that's a challenge stock. So why are you going from, isn't that Corning? Isn't GLW Corning? Yeah, it's Corning. Why are you going from Corning to Newell Brands? No. Let me. Newell Brands. You're really buying Newell Brands? No, you're not. You're going from Corning to Newell Brands? I'm in shock. I mean, I'm curious to hear your thesis, like briefly, I guess, because you can't really type much in the chat. But Newell Brands seems just like, is there something going on here that I don't know about? Because I've known about this company for a very long time. It's just in a sector. This is an unattractive sector. If you want to ask me what an unattractive sector is, it's this. Because even restaurants can be attractive. SLG, as it comes down. Going long toast, yeah. I wonder if that guy's still long Newell. Oh, yeah, I know who you're talking about. Is GEV overvalued? Debatable. I think relative to other things, it's still good. We had like a price target of like $1,000-ish a share. I believe it's like 933. So it's just like on a relative basis. Is it more attractive than other things? Probably not. But yeah, I think there was a lot of misunderstood monetization events that were on the horizon and starting in 2027 with turbines. But yeah. Retail tends to be unattractive. Oh my gosh, there's PayPay. Yeah, well, PayPay, the Japanese fintech. A lot of people are excited about that one. But yeah, Nike, Under Armour, Lulu. Yeah. I mean, I stay away from those. If I ever delve into that stuff, it's like, well, we traded Lulu, but we don't view it as like a hold. And Nike and Under Armour, or Nike in particular, a lot of people loved it. I don't see the appeal of these types of companies ultra long term. It's just hard to keep track of. But when we got talking about the aspirational luxury and true luxury businesses like Hermes and LVMH, I can get behind that. New brand tents, camping gear, and Rubbermaid. I don't know if you're joking or serious about the lots of folks moving into their cars nowadays. If you're not joking, then my laugh seems like a bit off-putting there. But if you are joking, that's a funny thesis. But no, if you're not joking, I'm like, well, shit. Well, the economy's going to shit. But they can probably execute a turnaround eventually. I mean, this stock's been in the dumps for a long time. It all started when that CEO, you can see right there, back in like 2017, they merged with another company. I forget the name. And they diluted their assets. They diluted their brands. You say people like Tiger. Tiger, well, I've never heard this name before. TIGR. Up FinTech Holdings. No, I'm not familiar with this name at all. Where are they from? Oh, no, China. I avoid all these. It's a just no stock. Yeah, I avoid all Chinese stocks. People banging the table on Zeta. Yeah, Zeta was one that Michael followed for a while. He was paying attention to like their short report kind of being a little bit meh. No, so like marketing tech, so that, you know, sell side and demand side, or DSPs and sell side platforms, SSPs. Zeta probably has a place. I don't know why it got like this retail fascination all of a sudden. In my view, if you want ad tech, I did a write up not too long ago on AppLovin. If you want a winner in ads, that's not Meta, that's not Google, that's not Amazon, because they have all these other things going for them in Amazon's case, and with Meta and Google being so developed. AppLovin, here you go. Business has stupid leverage in it. What I mean by that is like operating leverage, like stupid operating leverage. This company is just like, wow. So there, I spoke to some folks who work in the ad space. I'm trying to speak to more and more as I can. I just spoke to one of the ones in our server a few days ago, and you know, AppLovin, as far as like the challenger, the contender, the alternative, it's great. You know, you got 800 employees over here, 900, let's round up, and they're producing loads of cash. So that's operating efficiency right there. That's the craziness. And they're so far ahead of everyone else. So Unity, and there's another one I can't remember the name of, but Unity is another competitor, because Unity has the game engine plus the ads portion of the business. Their Axon platform for e-commerce is just killing it. So these guys are doing it. So if you want ads, I know the stock's up a lot, right, in the past couple years, but the market is pricing this one appropriately. It's a much better, or it's a much clearer story right now. Let's do some analysis. Good old Walmart. Walmart seems just too expensive for me. I just don't understand it. Looks like it's kind of, yeah, not doing much this year. It's up 10%. That's outperforming the market. But geez, like multiple expansion, continuous and endless among the retailers. I just don't get it. Now, well, I kind of get it with what's happening with Walmart. So there's been a lot of change with, you know, of course, the subscription revenue becoming a lot more meaningful. Walmart Plus has been a huge success. Advertisements being much more impactful. So they're getting all those benefits, and it's like a clean story, benefiting much from the same unit economics that Amazon has. And frankly, maybe the market's saying that the competition below that has just no way to compete. So then you have Costco, Walmart, Amazon, and then that's going to swallow up everything. I don't think it's going to swallow up everything, you know what I mean? But it's going to hyper concentrate in those guys, and then Target's just going to be left behind by comparison. Maybe that's what it's saying. Thoughts on economy in general? Recooked? No, I don't think so. Especially like, okay, so younger people, there's so much doomer content out there that it's frankly like I can't even fight against it, because I don't make much content public anymore, sadly, but I would like to. I'm going to be doing Wednesday 4 p.m. streams. Like, this is the day, this is the time I'm doing the streams. That's why you're seeing me today. But so you'll see me again next week at the very minimum. I might try to do like videos eventually here and there. But there's so much doomer content. Doomer content just like gets all the clicks. And, people love to say, the economy's fucked, this and that is fucked, the younger people are fucked. No, there's like, I can go over it, but like in the US in particular, I don't want to speak for every country, but in the US in particular, like the people are actually doing a lot better than before. Contrary to popular belief, but people are doing a lot better. Contrary to what the narrative that sells, people are doing a lot better. I had this whole discussion because like that is like the default opinion. The default opinion by people is like people are doing worse. It's like, no, they're not. But that could be its own video. It could be almost like a whole debate too, like bring people on and debate it, because there's a lot that goes into that. Oh, woo-hoo. Thank you. Good evening, Julius. Good evening. I got lucky on Nokia. Oh, well, to answer your question, my thoughts on the economy is like the economy is looking pretty good. Barring a discretionary pullback in spend from energy, because before there was like nothing. I was like, if you said the economy was weak, I was like, what the hell are you looking at? But now it's like, okay, there's a chance. There's a chance things get weaker if energy stays elevated. I laid it out at the very beginning of the stream. Energy stays elevated, pushes down discretionary disposable income. You get discretionary spend pullback, then that's someone else's income. Now you have what can be perceived as a slowdown, recession in a few sectors. And that could be problematic, especially globally, where energy prices are a lot higher right now. So we're not in any copper right now. It's something that's been looked at from the commodity space. You can just go long the copper ETF, but some of the commodity guys have warned me against copper in general because it's not as much of a shortage potential as people might think. Demand's going to be there, but supply can come online faster than what people realize, is what I'm kind of understanding from the discussions I've been having. But it's like figuring out exactly how quickly that demand's going to spike up. And then you're going to see like an initial knee-jerk reaction for copper before then supply catches on, and then you have a crash or a correction, better to be said. And you don't want there to be a shortage. That would be very bearish to the economy. I'd be very bearish for everyone else if that happens. Like, you do want things. Thoughts on the dollar? Not under threat. There any supposed threats to the dollar is like Fugazi. Well, REITs are always going to be a proxy for interest rates. So if you think interest rates, the longer end of the curve is going to go down, you go long REITs, because REITs will benefit from that environment, especially from the valuation standpoint. So just don't fight rates, because understand that when you buy REITs, you're buying a growing set of cash flows that is also impacted in valuation. Because remember, valuation expansion, so multiple expansion or contraction, are really powerful in your favor or against you. So if you think rates are going to come down, you're going to have multiple expansion, long-term rates. You're going to have multiple expansion in REITs. If you're going to have interest rates go up, you're going to have multiple contraction in REITs. So remember that, like, over the past decade or so, past 2 decades, 3 decades, you've had a structural decline in long-term interest rates. That has been a very bullish environment for REITs, where you got that tailwind from the multiple expansion plus the growing set of cash flows. Now you have the growing set of cash flows, depending on which REIT you're talking about. But the what's not there is the multiple re-rate or expansion potential. I'll name a Canadian company that is really good, and that's Main Street Equity. So I'm disclosure, I'm long Main Street Equity, a small amount, but it's one of the real estate firms that I think has been underlooked. And they're structured as a C corporation. They're Canadian. They focus on residential. The structure allows them to retain a lot of the cash flows and then reinvest it into new properties and the like. So that's one way, where that one's entirely focused on growing cash flows rather than because, like, with most REITs, they're kind of handicapped on how much they can grow because they have to distribute so much to shareholders in the form of a dividend. That's honestly a handicap in the REIT structure to some degree, and it's very inefficient from tax perspective in the fullest extent, because while it's efficient if you wanted to, if your goal was to pay out everything in tax, in dividends, it's not as efficient as if you wanted to reinvest everything. So it's the least efficient structure. Oh, I'm getting a lot of questions. See, I'll have to close this off soon, but yeah. Best advertising stock investment in your opinion? Beyond, I like Meta a lot here. Like I'm liking Meta at this valuation a lot, but AppLovin is good. AppLovin's a good business. Buyer beware on the volatility with AppLovin. Like, I'll repeat that. Buyer beware on the volatility with AppLovin. That shit is volatile. That thing can go up and down like crazy any given day. But business quality, great. I'd wait for a pullback more on Google, and then that one would be interesting again. Meta is interesting, and then Amazon for an advertisement business, but it's like got all these other moving parts. So pure play, one I could say is exciting is Meta and AppLovin. Zeta and all these other ones that are kind of like adjacent value adds. Yeah, sure. Reddit could also be interesting because they have a lot of monetization potential. I don't even know what price they're at. I think they're probably down a lot, but they have a lot of room for improvement. And we don't know what AppLovin's going to do, because AppLovin wants to buy one of these. AppLovin wants to either buy Reddit, Pinterest, Snapchat. It wants to buy a social media platform and see what they can do there. But that would be interesting when they do that. Glass half full, he says Amazon. Yeah, because Amazon's great. Amazon's pricing is just as bad as it was in '99. Only difference is you may be able to find 3 roommates and have none of them be a crackhead or alcoholic nowadays. I don't know why that makes me laugh. Okay, so any updates on Toast with the current macro? Bad news might be priced in. No, I think Toast is going to grow regardless. They're going to take market share from legacy systems. They're going to be very sticky, upsell on all their other products, grow in Europe, grow in hospitality. No, Toast is great. My long-term portfolio is down 13% year to date due to over trading and use of margins. Have a chance to recover if I get my head straight. Yeah, of course. 33% is not that bad. Yeah, 33% is not that bad. There, 33%. I'd say 50 plus is starting to get really bad, but 33% is not that bad. 30% for an individual stock portfolio is recoverable. Intra-year volatility like that is fine. Now, if we have a crazy correction from here and you're still, following the same sort of philosophy, yeah, you could get absolutely fucked. That could very quickly turn into 50 plus. But yeah. You think it's worth putting some oh wait, sorry. Don't want to ignore your hi. Hello. You think it's worth putting some money into Fannie or Freddie Mac in case they have the conservatorship and stock? I look at the preferreds first, but yeah. What price do you have? I don't do one stock, all in one stock. Yeah, REITs don't have to pay the corporate tax rate, but you still, as an investor, pay the individual tax rate. So tomato, you only get that like deduction, but the deduction doesn't really help you, especially if you're a high income earner. Kind of still fucks you. And if your goal is to compound capital tax efficiently, REIT's not the best. Is there a private credit company? What metrics you look for to look at? So you want to look at distributable earnings as far as like, shifting through the noise. Pay attention to unrealized carry. So they have ownership in these funds due to their performance. They don't realize them until they sell. So that's like untapped profit that they're going to realize. So for example, KKR has, I think, like $16 billion in unrealized carry. So you need a healthy IPO market to get all that cash out. But that's a lot of money for the size of the business. Think of it like that, right? And that's all this untapped capital. So that's one thing also to look at, because that's not shown in distributable earnings. Distributable earnings is the closest thing to free cash flow. That's like cash they could give you. They could hand it over to you. So that's what they'll call it, distributable earnings. They might call it something else depending on the business, but typically the standard nomenclature is distributable earnings. You can look at like their various BDCs to kind of get a gauge of how they're performing, but you're not going to get as detailed of a breakdown of the loan book as you would for like banks and etc. About my preferred ETF question, I noticed nothing. Oh, PFFA is the preferred stock product I'd recommend. So it's actively managed, but in debt products, active management is there's not that same inefficiency of like selecting the right manager. It's a lot easier to be a good active manager in like a fixed income, especially public fixed income, because the ETFs are pretty easy to beat, only because like how do you structure it? You just like programmatically or algorithmically say it was a market cap weighted ETF on preferreds. It's like, really, that's how you're going to do it? So it makes no sense. So it's easy to beat the preferred ETFs that are algorithmically handled, and the active managers find it a little bit easier to beat. Is private members call after this? No. So private members call will be tomorrow. If I do it tonight, you'll get a notification though, but I don't think I'll do it tonight. I have no opinions on GameStop. Paycom over Paylocity. I was asked about Shift4 earlier. My problem with Shift4 is complexity. Looks cheap, screams cheap. Crack is whack. I will be doing a stream every Wednesday. I don't promise 3 hours. I'll be doing a stream every Wednesday at 4 o'clock. Okay. With that being said, guys, thank you guys so much for joining me today. And if you guys enjoyed it, feel free to like, share, subscribe. Oh, yes, I bought today, Dave. I bought Dave today even. Someone just asked, are you still buying Dave under 200? Yes. In fact, all my shares of Dave are under 200 basis. But anyways, so yes, bought Dave today. All right. But with that being said, thank you guys so much for joining me here today. For full disclosure, everything I said on this podcast episode is my own opinion, does not reflect the opinions of Fractions Capital. Please do your own research. I'm not your financial advisor. The stocks that I mentioned that we are long, we may not be long tomorrow. It could be something that we get out of almost instantaneously. And if you guys are curious or interested in joining the Capital Mindset Club, the link is in the description below, where we have lots of voice discussions that we interact with. You can interact with me pretty much every single day if you want to. And other than that, if you're also interested in using finchat.ai, my link is in the description below as well. Other than that, thank you guys so much for joining today. Like, share, subscribe, share on Twitter, share on wherever you are. And I will see you guys on the next